30 seconds.
Really? They got their staff trained and they'll catch you. I live there, so we they'll tell you right up. And check. He's got another sheet on. Yeah. But yeah, you have to be there. If you want to really catch them, it's kind of hard. But I know you're only there every day. So close. The summertime we out and ask you. I don't worry about it too much.
He said, don't know about this.
Yeah.
One arbor, it's not exactly a. With no time area.
I understand, yeah.
Well, just think about that. When I was on 37, my parents
Yeah, that's, yeah. Good old days.
All right, we're gonna go ahead and kick this off. Welcome everyone to the first event of the year for the CBM, the Economic Outlook Summit. I'm Mike Tierney, the President and CEO of the CBM. Really glad to welcome you all here today. Whether you're joining us virtually, and then the brave souls that are in the room with us here, that sometimes people don't believe economic forecasts, and these people didn't believe the weather forecast, and they came anyway. So we're glad to have you with us. But we're also glad that a lot of you decided to join us virtually. 2024 is a special year for us at the CBM. We're celebrating our 50th anniversary of serving community banks here in Michigan. We've got a lot of fun events and celebrations planned to honor that legacy, but more importantly, to honor all the people over those 50 years who were significant in shaping the Michigan banking landscape. We had to do this virtually during COVID, so we're pretty good at doing it, and you're all pretty good at participating virtually. So we'll still have a great event today, even though the last 2 days, the scale tipped significantly from in-person to virtually. Would like to thank you all for your outstanding support of the CBM and for the great support you've given us for events like this. We do have about 115 people attending today's event, so thank you for that support. Also like to thank the CBM staff that's here today. Kate Engels, you're going to hear from her, our Chief Operating Officer. Sarah Cook's running the whole show today, so she's going to be busy. And then Carol's handling the registration, and Nanette. Oh, Nanette, she's probably listening to us virtually down in Florida, so I hope you're enjoying it, Nanette. Rub it in. And then we'd also like to thank the staff of the Henry Center. They do a great job for us here. We've started to have a lot of events here, and they have outstanding technical support. I can't stand to stay at the podium, so I'm going to start roaming around a little bit here now. Anyway, what?
I can't see you.
Okay, I gotta have to go back. Okay. Okay, there is a little difference virtually. How come there's no X down on the ground, like stand here? So this gets me off track right away. Right away, they got me off track. So we're at a Jimmy Buffett concert. It's a night in September and it's cold. It's like 45 degrees. We're in all winter stuff. Jimmy's up there. He's got the Hawaiian shirt on, shorts on, barefoot, like he does all of his concerts. And he's playing guitar and singing, and he would stroll away a little bit, and then we noticed he'd get right back to that spot pretty quick. Then we finally, like, the light went off. That's heated. He's going back to the heated spot on the floor. I'm not Jimmy Buffett, but anyway. Hey, we just closed out another record year at the CBM. We got the results from our accounting firm yesterday. Best revenue year in our 50 years. The last 3 years have been the best 3 years in the history of the CBM. And it's your support that helps us get there. It's the support of the bankers, the associate members that make all this happen. So we really appreciate you leaning into the CBM and helping us to make all these events successful. We had over 2,000 people take part in one of our events, one of our training sessions, or one of our forums last year. That was an increase of over 33%. So we really appreciate you getting engaged and getting involved. That's not the case across the whole country. Just want you to know why we're so appreciative of your support. Many banking associations across the country, because of the consolidation of the industry, have seen their revenues and their participation in events decline. So we're very thankful that we've been able to go the other way. Now, to really talk about today, today's economics forum, excuse me, we have a great lineup of speakers for you today. We're going to hit some key industry topics, try to shine some light on some of that for you. And we have some great special guests today. We have students from a number of Michigan universities. We have one in person with us here today, Ken Washington from the University of Michigan. Hey, Ken, thanks for coming. The national champs, he's still riding high with all the rest of the students. I'm surprised you left the party. It's probably been a celebration all week. And then we do have students, we got slide up. Oh yeah, there we go. We do have students from Central, from Ferris, from Michigan State, and from Michigan Tech, and Lake Superior State joining us virtually. So we're really glad to have all those students with us. Our banks are committed to making their communities better, and they're committed to making their communities better in every way. One of the ways they make their communities better is through financial literacy and financial education. And they take that commitment very seriously. So actually, it was at an event at Andy's Bank. It was his grand opening of Cub, and Jerome and I were talking, and we were like, you know, wouldn't it be great when we were students, wouldn't it have been great to be able to have an opportunity to go to an event like this? And that led to, first we invited the students from Ferris and the students from CMU, and then on and on and on to the other universities. So it's the first time we've done it. We're happy to do it, and we hope to have some students take part with us as we have more of these kinds of events. I can tell all of you students, there are CEOs, chief operating officers, CFOs, senior lenders, and other senior executives in our state from every one of your schools. No matter what school you go to, you have the opportunity, if you apply yourself, to be really successful. And I just wish when I was in school, I had an opportunity to do something like this. We hope that what you'll see today is all the things that you're studying in school, how they actually get put to use in the real world. And I think you'll see that particularly from some of our speakers. I remember when I was a college student, I couldn't figure out what did I want to do. Well, I ruled up marine biology really fast. I wasn't good enough at science. And politics, after a couple of poli-sci classes, nope, not doing that. Then I ended up a lobbyist. But what I was interested in was, I didn't know, you know, legal, career, insurance, banking, finance, accounting, one of those things. Anyway, I took a business law class. It was at 7:30 in the morning on Tuesdays and Thursdays. My roommate said, "Are you nuts? No, college students don't even start to stir until 8:30 or 9 o'clock. And you probably don't even have a class before 10 o'clock anymore, any of you. And I don't even think you have Friday classes anymore. But anyway, I took that class, and after that class, and it was taught by an Isabel Bank employee. He happened to be an attorney, and he taught business law. And the reason it was at 7:30 is he had to get to work. So we had class from 7:30 to 9:30, and then he had to go. But after that class, I knew I wanted to be a banker. Because I knew I wanted to be able to help people with their business. I knew I wanted to be able to help people with their personal finances and to be able to make a difference in people's lives. And he showed us how his job made a difference in the lives of particularly a lot of the businesses there in the Mount Pleasant area. So career banking may or may not be right for you. But if you're interested in a career, and while some of you are just with us virtually today, we'll share your contact information with the bankers that are here. And maybe you can make a connection and talk with the banker, either from your hometown or from a Michigan city you want to go to. And who knows how it might work out. Now I want to cover some of the upcoming events. Well, first I want to give a shout out to Hobby Group, and they're our sponsors today. We're going to hear from Mike Moran from Hobby in just a minute, but thank you so much for the sponsorship, because we can't do events like this without your support in making events like this possible. So we're going to go to the events slide there. All right. All right. Well, let's go through not the forums, but there we go. So the first thing that we have coming is really not a CBM event, but CBM has been a huge supporter of Folds of Honor. Folds of Honor provides military scholarships to Michigan military families. And by the time we have our golf outing on June 10th, we will have provided you, the bankers and associate members of the CBM, will have provided over $250,000 worth of scholarships for Michigan military families. And these are families who either lost a member in service or have someone who's been disabled or has long-term disability, like mental disability, like PTSD. So these are families that really need our help. And that Folds of Honor Gala is in Grand Rapids, Michigan. I think we've got information for you, but we'll send it out to you. It's at Noto's Old World on 28th Street. And again, that'll be February 24th. We have a great lineup for you on March 7th for the Directors College. I'll be right back here at the Henry Center. We'll share that with you probably in the next week or so, but we're really excited about all the speakers that we have there. And then, June 10th, mark your calendars. We'll have the Folds of Honor golf outing at American Dunes, and we're going to do it up big this year because it's our 50th anniversary and our third time to go out there to the club. The ICBA's got two big events coming on March 14th to the 17th is ICBA Live in Orlando, Florida. And coincidentally, one of the keynote speakers happens to be Dan Rooney, the founder of Folds of Honor. And Kate and I and Doug and Mike Burke and a whole lot of other people, we've spent 2 years talking to the ICBA about having Dan as the keynote speaker, and this year they did select him. He is one of the finest speakers. He's one of the finest individuals I've ever met. I would encourage you all to read his book, Fly into the Wind. And for you college students, there's 2 chapters. There's a chapter on volition, and there's a chapter on synchronicity. And I highly recommend that you at least read those 2 chapters. It changed his life, and I think it could be one of those things that could change your life. On the next major item, the ICBA Capital Summit. That's April 28th to May 1st. And that's our visit to Washington, D.C. to lobby, our senators and our congressional delegation. This is an election year. It's an important year. I strongly encourage all the bankers out there, maybe April 28th, May 1st doesn't work for you, then go with the MBA. They're going a little earlier, I think about a month earlier. But go on one of these. And if you've never been, that doesn't matter, because both associations will give you all the information you need to go and to be an advocate for our industry. And we pair you with an experienced banker who's been to Washington, D.C. a lot of times. So, they can kind of lead things, but it's really important that our congressional delegates hear from somebody in their district. If they hear from an association person like me, well, they listen, but they don't listen like they do to a voter. If you're a voter in their district and you're an important business person in their district, they want to hear from you and they want to form a connection with you. So we really encourage all of you to attend one of these 2 and have your voice heard in Washington, D.C. So now we'll get them all the things on the forums. Let's just we're going to preview today then. So you never know where things go at the beginning of a new year. So hearing from our experts that we have today, I think can really help us try to formulate our plans for what you want to do with your bank over this next year. I can tell you the last few years at the Economic Forum, the year did not turn out the way we forecasted it would turn out. That's no fault of anybody here. It just, it's been a different time. On the good side, we didn't have a recession in 2023. But we didn't see interest rates come down yet either. Maybe we will see that. But anyway, any of you who are online or in this room, if you have questions of our speakers today, one of the things that we want you, if you're online, we want you to use the chat room. Get your question in the chat room. Sarah will ask the question of the speaker for you. Speakers will ask you to repeat the question because they can't hear, our virtual participants can't hear the question Sarah asks you. So we'll ask you to repeat the question and then answer the question. And we may unmute you after a couple of the presentations, but use the chat function so that you can get in. And don't worry about the slides. Don't be trying to write down what's on the slides. We're sending the slides to all of you on Monday. So you will have all the slides and make any notes you want, but you don't have to make them. You're going to get the slides. But there's a catch. We're also sending you a survey to get your feedback on how this event, what was valuable to you, what you might like to see in the future. So we really, those of you who are here in person, we'll give you the survey. You can just fill it out before you leave. Those of you who are online, we're going to ask you to fill that survey out and get it back to us. And you college students, don't ghost us. We're wise to this. We're going to stay after you. We want your input too on what you got out of the event and how we could change the event going forward to make it more valuable to you. All right, so let's kick this thing off. Let's get going with our first speaker. We have a great kickoff speaker, and we have a great anchor speaker, and we've got great speakers in between. So our first speaker today is Mike Moran, Managing Director of the Hovde Group. Mike has a long banking career. All of you that are in the banking industry know Mike, and Sarah already told me I'm supposed to stand over here when I'm doing the introduction, but I don't listen too good. So, but now I'm doing it. Anyway, Mike has had a great career both in banking and in investment banking. He is one of the really knowledgeable guys about our industry, really follows it. He's one of the guys that I call when I want to talk about something in the industry because I know he's going to be on top of it. But anyway, he's a graduate of Dartmouth College. He's got about every license you can possibly have. And please welcome Mike Moran.
For those of you listening in virtually, I need to tell you that I'm currently getting a standing ovation. So, actually, and Mike hit it on the head. I went back through notes for the past few years, and particularly last year, the anticipated a couple of more interest rate hikes and then probable interest rate cuts in the tail end of 23 and a recession that was just around the corner. None of that materialized. So it's nice that we obviously always have an economist here talking, and I know there'll be folks talking about the political landscape in light of 2024. So I really add no value to these discussions, and I'm take comfort in the fact that there will be folks following me that will be able to fill in the details in terms of what's going on. I'd be remiss. Clearly, what occurred earlier in the week from an athletic standpoint was tremendous, and irrespective of your allegiance, it really was a wonderful event, particularly in light of the adversity and challenges that were faced by the team. But really, I think something we can all embrace. So without further ado, I did want to offer my congratulations to the Detroit Pistons. They won their fourth game in about 40 contests, and it's wonderful. And I really hope the Detroit Lions do well this weekend. So I think that covers all the athletic achievements. You know what, with this group, and I know there are folks listening virtually because Sarah's already handed me a note saying, unlike making sure Mike stayed within the camera's view, there's already been requests to have me step outside of the camera view so I don't ruin anyone's breakfast. But some of you have heard this before. I'm going to go through it rather quickly. It's high level stuff. I'm going to try and slide past anything of an economic interest rate type nature other than broad industry overview, because I don't want to step on Bill's toes when and candidly, I'm curious kind of what he thinks and what he sees on the horizon, because the talk out there is there are going to be 3 rate cuts, there are going to be 6 rate cuts, there are going to be no rate cuts. And when people ask me what I think, I just say yes to all that. So I honestly, it's going to be interesting to see how the year plays out. When I talked here last year, it was very probably about early, close to mid-February. So all the big banks and a lot of the regional banks had reported their year-end earnings. That has not happened yet. It is actually happening this morning as I speak. The big 4 banks are reporting. Jamie Dimon at JP Morgan Chase has already signaled that they expect they're going to have a good quarter. Earnings will be year over year down. No surprise. A lot of fourth quarter cleanup and FDIC fees and things of that nature, as well as continued reserve building. And we'll get into that a little bit later. The regionals will all report tomorrow. And I think it's probably going to be one of those rare times where investors, industry specialists are going to be not so much focused on the actual Q4 earnings, but what the guidance is through 2024, because there's a lot of things they want to get a feel for, how the consumer's holding up, what commercial real estate looks like, all those things that you hear all the time and are gaining some momentum. But more importantly, what the bankers are seeing and anticipating as they move through the year. And I was talking with Don a little bit earlier this morning. You're starting to see it a bit. The industry has been doing really well. Its asset quality continues to be pristine, but there's already signals with regard to cost cutting initiatives and efficiency drives and laying people off. And pulled up a statistic, and the big 4 have already reported, or the 20 largest banks, I should say, across the country have already reported that they've cut about 60,000 jobs so far this year. And if you remember back through the financial crisis in 07, 08, there were about 140,000 jobs amongst that cohort that were cut. So not to say that they're on the front end of maybe more that's coming, but I think it's a signal that they anticipate it is going to be tougher sledding as we move through 2024 into 2025. So when you only have so many levers you can pull with regard to getting to your bottom line, cost cuts is one of them, and that usually means efficiency drives that start to cut back. So like I said, I'm going to go through these rather quickly. The first is really just a quick overview, broad brush with regard to the economy. I won't spend really any time on this because I know Bill's going to dive deeper into a lot of these things. But and you'll all, as Mike said, you'll all get these materials, and I, if you want to talk after, or if anything comes up on any of these slides that you feel like I've kind of glossed over, it doesn't mean that I don't want to talk about it. It probably means I just don't understand it and can't talk about it. But feel free to stop me at any point. But again, these just very high level, the inflation related to COVID, the AOCI type adjustments in bond portfolios, what that's meant with regard to M&A environment, the M&A environment really coming to a standstill in the banking industry, in a consolidating industry that typically sees 3, 4, 5% of the industry disappear every year, and it really just came to a halt. And then the unknowns with regard to, is the Fed going to continue to, or what its interest rate policy is going to be as we move through 2024. These are just, again, very high level issues with regard to the industry. Everybody's focused on what the Fed may or may not do, and the inverted yield curve that still exists. If you remember, we talked about this last year. It has not changed. If anything, it's broadened in terms of the 3-month 10-year split has gotten wider. The 2-10 is still inverted. That has historically always kind of signaled a recession is around the corner. That recession hasn't yet developed. There's hope. The equity markets, you saw that through November and December, where there was a huge rally in the broad equity markets, but particularly the banking sector, in anticipation that the Fed would probably start cutting rates this year. But it is still inverted, and the hope is, are we looking at or in the midst of a soft landing? That's a wild card because as Jamie Dimon, and not to toot JP Morgan Chase's horn, but as he's talked about, there is still, in his view, and he was interviewed earlier this week or late last week, I don't recall, a lot of cash sloshing around the system, and it has resulted in also a tremendous level of debt in our country that now exceeds $34 trillion. So you let that sink in for a second, and what the implications of what that might be over time, it's going to be interesting. With regard to the banking sector, as I said, they were way underwater through 23, rallied in the last couple of months to just kind of get back to a decent kind of performance, with expectations that we're going to have lower rates, better margins, asset quality is not going to be a disconcerting issue if we don't go into a recession, things of that nature. But it's still an unknown as we sit here today. The bank equity pricing bouncing off its lows, as that third block of information talks about. PE multiples, I know I've talked with a bunch of you in this room, and I'm sure those that are virtually listening in. When I was a banking analyst back at Roni back in the late 90s, I'd see these kind of numbers with regard to price book, trading range, price earnings levels. And I'd get on Squawk Box at my Roni office and just say, kind of a collective, back up the effing truck, because they just don't get this cheap. And you see bank stocks, and you'll see in a screen later on with regard to the Michigan traded. There's about 20 that actively trade across the state, and they're trading at 6 and 7 times earnings. Now, that usually means that the market is saying not so much they expect an adjustment to the P in the PE ratio, but more so to the E, that the earnings are going to come under pressure, they're going to come down. And you've seen that industry-wide, where estimates, there's only a handful in our state that are actively followed by the research community and have actual forward estimates printed on them. But when you look at industry-wide, 5 to 10% kind of cuts in terms of estimates for 2024, but then a pretty significant rebound in 2025. So most investors are anticipating kind of a down year performance-wise, bottom line performance-wise for the sector, but have rallied behind the anticipated interest rate environment and the hope that asset quality will remain pristine in terms of getting behind bank stocks. We'll all find out in due course whether it's been overdone or was fairly accurate with regard to where they're trading. And as I touched on earlier, bank M&A volume came to a standstill. Michigan was no different than the rest of the country. You'll see in a slide that comes up later. Again, as I've said, 3, 4, 5% of the industry disappears every year. And we had a dramatic fall off because the uncertainty, banks use their stock, it's their currency, typically when they're buying another bank. When that's under pressure, that usually mutes activity, as well as if there's uncertainty on the economic environment. The last thing a bank CEO wants to do is have to explain to investors why they bought somebody with unknowns about their loan portfolio when they aren't even sure what their own loan portfolio may look like or how it may perform in the coming environment. The Fed, the rate hikes, it's all been talked about. Again, I don't want to spend a lot of time on this, but typically we've seen something break. The liquidity crisis that came in March feels like a lifetime ago, but it was just less than a year ago when those banks went under. And speaking of that, a lot of detail, won't go into it, but I will remind you, and I know I've talked with a few about this in recent months. This is back in March, so less than a year ago. But you have to recall, I know it sometimes feels like it was a long time ago, how quickly things unraveled. When Silvergate signaled that it was going to effectively liquidate, that started rumblings with regard to what levels of uninsured deposits banks held across the country, started literal technological runs on some institutions like Silicon Valley and Signature. Silicon Valley was trading at $270 on Wednesday of the week that it went under, $270 a share. By Thursday, as Silvergate's news had hit, its stock traded down into the little over $100 range. Friday, it was gone. It had a market cap of $60 billion right before it went under. It was trading in the low $100 range on Thursday. Friday, it was gone. Everybody else then came under pressure. Signature was on the East Coast, a good example of that. It was trading at $90 about a week before all this happened. The Thursday, it traded, broke below $100. By Friday, it was $70. Silicon Valley's been seized, Signature trades down to $70, has a market cap at that point, which is simply the stock price multiplied by its shares outstanding. Excuse me, had a market cap of $45 billion. It never opened on Monday. It was gone. It disappeared over the weekend. Think about, and normally, as all of you know, when banks go under, typically there's signs, tarps put over the signs out front, and management comes in, the FDIC cleans the books, and they reopen Monday under a new name. Took a few weeks for all of these to get resolved. One of them, the owner, New York Community Bank that owns Flagstar, is the one who absorbed Signature a few weeks later. They had a lot of overlap in the metropolitan New York market, but it was staggering that it took that long to get these things resolved. And it wasn't just here. Overseas, Credit Suisse, UBS, which ironically, UBS had bailed out, Credit Suisse and UBS had been involved in bailing the other out during the financial crisis. When that entity was sold for a little over $3 billion, as you see in one of the bullet points, that was 7% of book value of that organization. That's 70%, that's 17%, 7% of book value. And it disappeared. The rest, again, all history, but we had three of the largest failures, over $35 billion in cost of the FDIC that occurred back in March. So understandably, when you look at stock charts, industry-wide charts, and you see the dramatic fall off that largely mirrored what we saw when COVID hit back in March of 2020, it was understandable. There was clearly panic in the markets. Comerica, I'll back up for a second. I don't think there's a Comerica person in the room, and this is not to kind of cast aspersions on them. But Comerica was an $80+ stock a little over a year ago. When all of this started unraveling, Comerica hit a screen with about 8 or 10 other banks that were profiled as having higher levels of uninsured deposits to their overall deposits. So simply hit this screen. No discussion about their fundamental performance, what their loan portfolio looked like, what the business profile was for the organization and its markets. Purely, they were a data point with uninsured deposit levels that didn't mirror what happened at Signature and Silicon Valley, which were north of 90%, but were in that 70-80% type range with a handful, about a half dozen other names. Had been an $80 stock, traded down to $58 the Friday when all of this was happening. Signature fails over the weekend. Monday morning, Comerica opened at $29 a share. Opened at $29 a share. Today it's back around 55 or so, still well below where it was about a year or so ago in the 80s. But it kind of showed how dramatic the spiral down was for a lot of folks. It was absolutely staggering. Bank failures, as I talked about, you have to go back to the days of WAMU to see the kind of asset size that were disappeared, but you had three banks that went under that were over $500 billion in assets. $500 billion in assets. And like I said, took then a few weeks to get those entities resolved. First Republic was interesting because the big four in the US infused money to effectively bail them out. And all it did is it bought them another month of time before JP Morgan Chase ultimately bought them and absorbed them into the system. So the numbers that you see are staggering. This, if you look from the right-hand side across to the left, you'll see that over time, typically quarter to quarter, AOCI type, meaning your bond portfolio, where it currently stands at each quarter's end, immaterial with regard to plus or minus. It's where you park some extra cash, put some things to work, because we've been in a zero rate environment forever and a day. And then over toward the right-hand side of the screen, you can see the impact that the Fed rate hikes had on the industry. Roughly $700 billion as of Q3. And as I mentioned, it would be great to be able to stand here and talk about Q4 numbers and what expectations are, guidance is for 2024, but those are just coming out now. So we anticipate that that will have shrunk a little bit with the rally in the bond market, but still is a significant factor for those that may need to raise liquidity and why the regulators are so focused on it. You look at, won't go into this, I'm sure the economists will talk about it, but the fastest, quickest, steepest rate hike in history that we had, over 500 basis points in less than a year and a half versus what we've seen in prior cycles. This graph simply shows kind of where core inflation looks like that mountaintop across in the background, what it's looked like with regard to the rate hikes that have come and where we are now with the Fed's target inflationary rate of 2% is. When word leaked, when Powell kind of was a little bit more open about a possible pivot this year with regard to rate cuts, the banking sector rallied, the future markets adjusted with regard to what they anticipated the Fed might do. It's a little bit all over the map. Bill probably or may go into it in a bit more detail with regard to what the futures market is saying with regard to potential rate cuts. And it's still an open item. I think I sense, I don't sit in that room, I don't walk in his shoes, but I think Powell wants to be more aligned with the Volcker type Fed efforts of taming inflation than the Arthur Burns legacy of stagflation through the 70s into the early 80s. So I believe the Fed is focused on trying to get that under control, enough moving pieces though that make it still a bit of an unknown. If you look at economic growth, again, just printed or will print soon with regard to what GDP looks like closing out the year. But as I mentioned before, US debt is at $34 trillion in a Congressional Budget Office estimate back just before the pandemic hit. When they look out over time, they anticipated the country would get to that level in 2029. 2029, we're there today. 34 trillion and growing, and the implications that it has on our economy, it's what everybody's trying to kind of figure out as we move forward. Unemployment rate, again, usually you see these kind of rate hikes, and unemployment starts to creep up. It is still in a low 3% type level. Historically, even Michigan is actually today slightly better than the national average. If you remember when the pandemic hit, national average climbed to about 15% virtually overnight. Michigan was nearly 25%. Nearly 1 in 4 jobs that were idled, sidelined during the pandemic. Obviously, the nation and the state have recovered significantly since then, and it bodes well with regard to the overall economy, these kind of unemployment levels. But it only makes Powell and the Fed's job that much tougher as it's trying to tame inflation. The deposit type mix, we kind of brought this out. It really underscores a lot of the stimulus that got pumped into the market through COVID. And it created this huge gap with regard to banks trying to put that cash to work. The gap has been closing, but it's still rather significant today. And now in an environment where deposit pricing and competition has really ratcheted up as folks want to ensure they have adequate liquidity on their balance sheet. So the environment really kind of shifted from, and Wall Street's fond of using acronyms and particularly women's names, but went from TINA, there is no alternative with regard to investment objectives, to TARA. There are reasonable alternatives because now you've got treasuries at 5%. So it's easy then to kind of park the money there for a consumer. That has created pressure with regard to deposit funding for the banking sector. You look at, a lot of detail, don't want to dive too deeply into it. More than happy to discuss it if anybody wants to go a little bit deeper, but you can see kind of middle of the page where when the liquidity crisis hit and the run of deposits out of the sector, and surprisingly, when you really think about it, because it was big banks that failed, not the big 4, but $200 billion entities in Signature, Silicon Valley, First Republic, and so on. The community banks were the ones who took it in the shorts with regard to deposits. The run out of the community banking, smaller banking sector in March of 23 was staggering. And the big banks actually gained deposits because it was viewed as, well, the Fed, the US government are not going to let Citicorp, Bank of America, JP Morgan Chase, Wells Fargo fail. But these little guys don't know. So they had this deposit run. It has since reverted back. Both have held up well. A lot more has actually come back into the community banking, smaller bank sector, which is comforting because, again, they operate, as you all know, in your backyard, in your, you know your markets, you know your neighbors, you know your customers, and there's a lot of comfort that investors historically have taken in that dynamic. Headwinds are clearly in front of us. Margin compression is a real thing. It was initially with the rapid rate hikes, you saw margins expand, as this chart kind of highlights. That has now come under pressure as funding costs are starting to catch up to it. If the Fed cuts rates, there's this interpretation with regard to, or investor expectation that, sure, you're not going to get the same kind of asset yields on the loans, but at least will help alleviate some of the pressure on the funding side, which should bode for healthier, stronger margins. So again, time will tell. And I know when we talked with a lot of clients, when you look at what happened in 20, 21, 22, a lot of noise in the income statements of just about everybody with PPP loans and mortgage banking activity that was in a state of nirvana, credit related adjustments, initially huge provisions that were made in anticipation that there could be a significant downturn and the unknown with regard to how long the pandemic might last, and then reversals. So a lot of noise that distorted numbers. We're now returning to a more normalized kind of environment. And why, again, I think investors will really be focused on not only the fundamentals of Q4 earnings releases, but what kind of guidance the bigger banks are giving in terms of what they see on the horizon. Net interest margin, just talked about it, under pressure. Again, I'm going to kind of slide through these pretty quickly. We anticipate, or market experts kind of talk to, they expect that there probably was a bottoming out of margin compression through the fourth quarter, may still, depending upon your mix and duration and all those kind of things that also have implications with regard to AOCI type adjustments, that we probably have seen the worst of it, or maybe it plays out early into 2024, but then hopefully rebound, stabilizes and starts to build, particularly if there are rate cuts coming and you see some pressure alleviated on the funding side. But that is right now what has was one of the major causes or material causes of the dramatic downturn with regard to bank stocks through the spring and summer of 23. You look at, we just kind of brought some more so you could see a bifurcation over to the left-hand side between the bigger banks, the banks we have in our coverage, research coverage universe versus the smaller banks. And then over time, what you've seen between the community banks, the regionals, the super regionals. So I think a lot of good, interesting data points when you're discussing with your colleagues, but shows, everybody kind of came under pressure. Folks are kind of pulling out of that a bit right now, but it all is a function of what the rate environment looks like. Credit quality has been pristine. I've been using that word for, I feel like, the last 15 years. And if you look at probably, I think, I don't want to cast any dispersions on my colleagues. Actually, a colleague of mine, Kristen Vaughn, is in the room. And anyone who has met Kristen or dealt with her in the past knows that she is truly the brain trust in our operation. And I just sit up here and I, kind of a puppet master, get my strings pulled. But Kristen is kind of the quarterbacks, amongst other colleagues, our analytical capabilities back in our home office, pulls all this information together to try and make me look at least semi-intelligent. And those of you in the room, and I know those virtually listening in can confirm that that is a Herculean task to make me look intelligent. But Kristen somehow does a pretty decent job. I would point to, of all these, the chart in the upper right-hand corner, because it gives you what the long-term average is for the industry going back about 20 plus years with regard to net charge-offs. We're all, if we've been around a while, are used to hearing, it used to be 30, 40, 50 basis points in net charge-offs. And the industry was pretty much standard. And then coming out of the financial crisis, banks were building capital levels, they were reserving, they were probably strengthening their underwriting because of being happy to have survived and made it through, as well as position themselves to be stronger going forward. And you see, with regard to the dotted line versus the solid line, where the average kind of ratcheted down with regard to net charge-offs. The blue boxes are what expectations are going out forward. Now, that is in anticipation that there's not any kind of significant recession around the corner, because that will change all of this, as well as depending upon the mix for organizations. But industry-wide, it is anticipated we'll see a reversion to the mean with regard to charge-offs for the industry. It has been, like I said, pristine for quite some time, and that dynamic, I probably have said it every year, can't continue to hold, and yet it does, but at some point it's got to crack. With regard to a capital markets update, again, we tried to look at common equity, preferred equity, subordinated debt issues that have crossed the industry over the past 7-8 years. And you can see it's that dark blue box across each main category is the most recent year, 2023, where it literally fell off a cliff. And that was just because of the uncertainty in the markets, bank stocks being under tremendous pressure, and the unknown in terms of what might be around the corner. So not anything new with regard to this. Capital levels continue to be very healthy, very strong, even with AOCI type adjustments. Again, coming out of the financial crisis, most folks recognize capital is king, and you need to make sure you've got adequate reserves and capital levels to survive whatever downturn might be down the road. So statistically, across the bottom, you see over the past 20 plus years where that has gotten stronger over time. Leverage ratios, risk-based ratios, again, all very, very solid. AOCI adjustments aside for some that are under a bit more pressure, but so long as they are not forced to liquidate their bond portfolios or take significant hits, not really an issue. We have one here in Michigan that's under pressure optically, but is performing very well and doesn't have any operational type issues. But it is something optically that is disconcerting and something the regulators clearly are focused on should we see the liquidity pressures that we saw back last March. In terms of the bank equity markets, we looked at the S&P versus some bank indices, and you can see where that kind of box in the upper part of the page where they were flat to off significantly, and that's with a strong rally in November and December of this year versus the S&P 500. This brings out kind of what we've looked at in terms of where the 10-year Treasury trades, and you can see that red line starting to ratchet up and the banking sector starting to fall off as the Fed began raising rates. So there's been a pretty good correlation between where's the 10-year, where bank equity is trading. Will that hold over time? Historically, hard to see, but you can see then toward the right-hand side of that graph where the 10-year started to come back down with the anticipated Fed rate cuts and the bond market responding to that, and bank equities have taken off again. So that again, we'll see how that plays out. I think this is probably a good slide to digest for folks in the room for their boards and their strategic planning sessions with regard to, you can make, much like cable TV, whatever opinion you want to align with. There are easily 500 channels that will tell you one extreme and 500 that'll tell you the other extreme. So you can align with whomever you want. This is kind of a bear and bull case for the banking sector with regard to what the unknowns about what might be around the corner, where valuations are right now, what we might see with regard to margin compression or additional margin pressure. And if M&A does start to pick up as there's more not transparency, but better visibility in the market, that has always been kind of rocket fuel for bank stocks, understandably so. And it's been, like I said, at a standstill. The regional bank index, we just took that slide from earlier and looked at through from the beginning of 20 to 2023. And you can see where the S&P has been up nearly 50% and the bank stocks have been off 10%, even with the recent rally. The flows in and out of the banking sector in terms of the different funds that have been volatile over time over the past few years, again, given kind of the psychotic activity in the sector. We looked at that earlier slide just for this past year, 2023. And again, even with the rally in the last few months, the regional bank index off 11% versus the S&P being up 25%. This is to the right-hand side, simply looking at the start to the year, nothing really significant to show of it, but the market's relatively flat. I don't know what's going on this morning. I don't know how the bank earnings have come in and how they're being interpreted. But when we looked at this, like I said last year, you can see where the 2-year, 10-year spread, and we also look at the 3-month, 10-year spread because at times at its historical significance, where it continues to be inverted, and usually that is a fairly good signal that a recession is around the corner. What that might mean, again, we'll all know in due course. As I mentioned earlier, valuations in the banking industry. Under pressure, you have AOCI type adjustments, so that distort price to book value valuations because the book value is lower optically because of the bond portfolio losses or perceived losses if they were to sell. But the PEs that have come down, like I said, I'll get to a slide pretty quickly that looks at the Michigan-based banks, and you can see how dramatic that's been. But PEs have broken into a single-digit type range for the industry that typically were at 12 to 15 times earnings and 1.5 to 2 times book value for the regional banks. These are the bigger ones. The smaller ones have usually a liquidity discount, and meaning that they don't trade as often, not liquidity with regard to their balance sheet, but they just don't trade as often, so they tend to be discounted with regard to the investor market. We look at, again, Kristen and our colleagues back in the home office that then cut things, slice things 10 different ways to Sunday and look at different size banks and regional breakouts and things of that nature. But you see across the industry where price book and price earnings multiples have been altered through the different asset sizes over time. And it hasn't escaped anyone really in the sector. The larger banks typically trade at stronger multiples, again, largely because of liquidity and transparency. They're just a lot more detail, a lot more information, easier to get in and out of. But nonetheless, the sector has come under pressure. These are the Michigan publicly traded, about 20 shops. And you can see, if you look to kind of pull you over here, and the AOCI aside, and the larger ones, and again, Michigan no longer has, and I know you've heard me say this in the past, a $10 billion shop headquartered in the state. First time in roughly 40 years when NBD crossed that threshold that we do not have a $10 billion commercial bank headquartered in our state. So if you look, the larger ones, which are the Independents, Mercantiles, Macatawas of the world at $5 billion, they traded about 125% of book. The smaller guys are currently in about an 80% of tangible book value type range, but the PE multiples are what's really distorting. Again, the larger ones more along the lines of what you saw in an earlier slide at about 9 times earnings. The smaller ones about 6 times earnings. Now, part of that is there's just not a lot of detail. So the investor market then discounts even deeper when there's any kind of uncertainty, because it's harder to get out of those stocks. And a trade can have a huge impact. A small trade can have a huge impact on a small community bank stock for no real fundamental reason other than someone simply wants to cash out and move on. Not the same kind of thing. You'd see, we typically have a column in here that looks at average trading volume on a monthly basis. And you'll see the larger ones trade 4 or 5% of their stock monthly. The smaller guys will be less than 0.5% of their stock, because it just doesn't trade. It gets stuck in a mattress, gets stuck on a shelf somewhere, a grandchild's account, 10 states away, whatever the case might be. So when it does trade, if there's good news behind it, it can pop significantly in fairly short order. If there's uncertainty in terms of the industry, it can get discounted and hit pretty hard. So again, don't want to single anybody out in particular, but more than happy to talk about statewide what we're seeing and what we're anticipating with regard to bank stocks. The deposit trend, I know this is a painful kind of chart for all the community banks in the room, but it is the reality. And as the yellow call out box highlights, the largest entities left in our state are credit unions right now. It is just a function, the three largest depositories are credit unions. I think the call-out box says 6 of the top 10, 12 of the top 20 are credit unions. And that's not changing. That's just the way it is right now. The Comerica's, Michigan Nationals, MBDs, First of America's, Old Kent's, probably missing a handful of different names. They don't exist anymore. They're long, Comerica technically still around, but based in Dallas. They don't exist anymore here in Detroit. If you look at a slide in terms of what kind of deposit composition in the state is controlled by out-of-state banks, take the credit unions out of the equation, and you'll see it's 70% plus. Don probably knows it by heart, higher than 70% are controlled by out-of-state banks. It is just a function of what's happened in our state through industry consolidation. And Michigan's not much different than other states in the Midwest. With regard to the M&A environment, I don't want to spend a lot of time on this. I think it's just good information that you can all kind of absorb and look at your leisure. We have kind of a red light, green light, yellow light for different factors that typically historically influence M&A activity. Not long ago, a few of these were in the red zone, particularly with regard to bank stocks and market uncertainty. They've shifted yellow. Tech will probably always be green because that is just a dynamic that is reshaping the sector at large. So community banks in general are not immune to it. And the regulatory environment is, I think the regulators are trying to push consolidation in that, call it 50, 100, $150 billion range, where the Silicon Valleys, the Signatures, the First Republics of the world operated. And they've held up the larger shops. But there just hasn't been a lot of activity anyway. So hard to draw any strong or definitive conclusions with regard to that. As there's more visibility in the market, we anticipate this will pick back up again. Historically, and this is kind of just a couple of quick slides with regard to the tech impact and dynamics that you see and the competitive pressures that community banks and banks at large are dealing with. And I know we've talked about this in the past, but it is, again, it is what it is. And the ability to leverage your data processing partner with regard to technological type things is become critical. More M&A statistics. That upper left-hand corner just shows the shrinkage in the industry. Someone had asked me, you know, is the same kind of occurred because there's so much talk about when credit unions are buying community banks. The same has occurred in the credit union sector. We've seen about a 70% drop over time in the last, call it 35 years in the commercial banking sector. The credit unions have shrunk about 60%. So really not much different. Again, and typically larger guys that are or folks that are gobbling up smaller ones. And Michigan is no different. When I first moved back here from the East Coast, there were over 300 charters in the state. That's back in the late 80s, early 90s. There are, Don, you can fact check me, 75? Yeah, so 70, call it a little over 70. So same kind of dynamic here in Michigan as you've seen nationwide with regard to consolidation. A lot of charters that have disappeared over time. Again, more statistical data on nationwide M&A activity over the last 15 or so years that you can absorb at your leisure. But again, a dramatic fall off in 2023, isolating it to the Midwest just to see what kind of dynamics, because sometimes you see regional differences with regard to the Sun Belt states and such typically have higher valuations because they're in more demographically compelling markets. But at the end of the day, the economics are what drive these transactions, and they're really not that much different. Some detail with regard to Michigan activity. You saw, much like across the country, here in Michigan, where there was a dramatic fall off when the pandemic hit, another dramatic fall off as the Fed started hiking rates. So really, Michigan, no different. Take comfort in that. But not a lot of activity in 2023. A few transactions that we've seen in the state. There have been, if memory serves me correct, there have been 4 community banks, usually unique situations that have been bought by credit unions. So not the same as we've seen in other states with regard to the level of activity. And I think it just hit the wires yesterday or 2 days ago. A large $12 billion plus credit union in Alaska is buying a $1.5 billion bank just south of Seattle, Washington. So it's no longer a credit union buying some mom and pop community bank in the outskirts somewhere that nobody really knows where the town is. They have moved into very compelling, demographically compelling markets and doing size transactions. This just a quick heat map. Again, Michigan kind of aligns with the average with regard to transactions over the past few years. Pay to trade, that is simply your stock, your currency. If you're trading at 150% of book value, you have more flexibility to go buy somebody at 125% of book value because you're really kind of in a way using monopoly money. So they call that the pay to trade ratio. And you see activity pick back up when valuations start to rise with some of the mid-level larger players because they then have the currency to be a bit more aggressive going out to price transactions. The credit marks and interest rate marks industry, the last couple of slides give you a feel for what expectations are. Interest rate marks started to pick up a bit. And these are just kind of deal by deal over time. And if I go back, you see the kind of the same with regard to credit marks industry wide, but the uncertainty with regard to the economy and what that might mean from a credit perspective means someone wants to go into, a buyer wants to go in with a better feeling, a little bit more cushion. Interest rate marks are what they are depending upon what's happening in the bond market and with yields. So again, kind of a quick snapshot with regard to M&A. We anticipated probably still a little bit of a continued lull into 2024, but we'll pick up if there is not some dramatic economic downturn, should pick up through the spring, summer, into the back half of 24. Again, you see 3, 4, 5%. That usually means industry-wide 200, 250 banks disappear every single year. Now, historically, as Mike and others in the room, probably almost everybody in the room is familiar with, pre-financial crisis, the industry minted 100, 150 new de novo banks every single year across the country. On average, about 150 banks a year. So you lost about 250, you gained about 150. It wasn't a one-for-one kind of backfill, but usually it unleashed a lot of talent, created opportunities in different communities to want to have local representation, local banking. So think about then what's transpired coming out of the financial crisis. Don't have that chart up here right now, but I can tell you there were about 2,500 banks starting in about 2011, 12 that were consolidated out of existence, were bought by other players. About 500 plus failed coming out of the crisis. So over 3,000 entities disappeared. Normally, we would have had about 1,500 to 2,000 new banks formed. There were less than 100 across the country. I think Andy is about the only one in Michigan of late. And it was, other than Rob Farr, about 5 years ago at my bank, it was about 10 years before that we saw any kind of activity in the state. And Michigan is not an anomaly. That is what you're seeing across the country as regulators kind of stepped in and said, you know what? A lot of smaller guys failed. You need to raise 30, 40, $50 million to start a new bank, which is insane. So de novo activity clearly has come to a screeching halt. Hopefully it picks up. Will it ever return to the historical levels we saw pre-financial crisis? It's never going to happen. But at least some backfill would be surely appreciated. And this is just, again, a just kind of catch-all overall. I know we've got a little bit of time, more than happy, as long as we don't talk about University of Michigan football. And not that I have any dog in the fight. Like I said, I'm from the East Coast. I've had kids actually attend just about every Big Ten college across the landscape. So I have to be Switzerland and neutral come Saturdays during the fall.
How many kids do you have?
That I know of, Don. Yeah, I've got 4 representation.
Talking about the old Big Ten.
Yeah, exactly. Yeah, Michigan State, Notre Dame, got Illinois. We're all covered. So, but I think this is, again, we are continue to be long-term, near-term, long-term, very bullish with regard to the community banking sector. Going back to my Roni days, dating myself, but 30 years ago, if you picked up, and Mike and Don and others can attest to it, you got a good bank with good operators in a decent market, and you knew you could sleep well at night, boy, those were great investments, and they usually paid out pretty nice dividends, and you sat on them forever and a day, and that got my kids through those Big Ten schools. I can tell you those investments over time. I still feel that way. The industry has shrunken significantly. Michigan, as Don attested to, 72 charters left in the state. There's a limited universe right now as we sit here today, but there's some really, really good shops that carry these valuations that, yeah, sure, there may be blips in the night or trading anomalies that are going to bounce them all over the wall at any given point in time. But over time, you should be fine if you get behind good operators. And the state has a lot of really, really good operators. So again, the unknowns are not saying anything out of school. We just don't know what's around the corner. Again, it's why I mentioned I add no value to this session. When Bill talks, that'll be when we all get some kind of, I think, insight with regard to what might be around the corner, what might lie down the road, because I make this stuff up as I go along. But I think with that, I don't think I have any other slides other than maybe my first communion picture and Kristen, who's sitting in the back of the room. But more than happy, if anybody has any questions, I'm more than happy to address that. We have a nice small group in here that has braved the impending snowstorm. So anything you want to talk about, more than happy to.
I put one in the chat.
Okay.
It is, with the Fed expected to cut rates this year, do you see these cuts unlikely to reduce NIM pressure in 2024?
Okay, so I'm sure everybody in the room heard it. For those virtually, as Mike wanted me to repeat the question. The question was, Mike, how are you so damn charming and personable? Was that, no, that's okay. I think it was the question, Sarah, correct me, with the Fed expected to cut rates. Will that alleviate margin compression or margin pressure? It should, holistically, with regard to just kind of pulling back some of the pressure on the funding side. Will clearly, you would see or anticipate seeing some dip with regard to loan rates if rates come down dramatically. But I think it's more folks bankers are anticipating or hoping that if it can help alleviate funding pressure, competitive issues on the funding side, that's all very positive. And I know why we saw the kind of rally in bank stocks in November and December, when that seemed to be the signal that was coming out of Powell and the Fed, that we were probably looking at cuts, and the banks took off. Not bad for making that up on the fly.
Hey, Mike, as you showed us in the slides, there was virtually no capital raises, no equity, no subordinated debt other than one transaction. How do you see that in 24? If we start to get some rate cuts, do you think that opens up a little bit for banks, or they could raise some capital if they wanted to try to do a deal?
Yeah, Mike's question was basically if we see some kind of pressure on the rate side, if the Fed does start cutting, does that maybe help the capital markets as entities look to raise debt or equity to support growth and such? And the quick bottom line answer is absolutely yes. I think I know our firm is positioned. There's a lot of talk. A lot of folks are trying to, how do we move from maybe through the crisis, through the pandemic, through the rate hikes, a defensive posture to more of an offensive posture. The economy doesn't go off a cliff. How can we maybe bring in capital to support growth in our markets where the bigger guys have abandoned a lot of these communities? So I know that as valuations start to get at least a bit of a floor underneath them and a sense of a more optimistic picture, that makes it easier to go out and raise debt, equity, whatever the instrument might be. And clearly, as valuations pick up, I think that that should give folks a flexibility if they desire to pursue that path to do it. But right now, in the subordinated debt market, and Kristen, correct me if I'm wrong, but you're looking at coupons that are 9 or 10% because the market interprets up until maybe a few weeks, a month or so ago, but the market through most of 23 interpreted if you are out raising, particularly if you're out raising debt, you needed it. because you saw something that wasn't yet apparent to the rest of us, that there was a shitstorm coming. Today, I think that now is off to the side, that as things start to strengthen, there'll be more flexibility with regard to raising capital in the markets.
I've got one more.
Sure.
What are your thoughts on the commercial real estate concerns coming down the path in the next 18 months or so?
Okay, Sarah's question was my concerns about commercial real estate. I can tell you, I'm trying to rattle through it. There's not a lot of information up here, so there tends to be, when there is a thought, it bounces off the walls fairly actively. So it's hard for me to organize my thoughts. But if you looked at the bigger banks and the regional banks, they started provisioning rather significantly in the second and third quarters, and we anticipate we'll see it also in the fourth quarter for commercial real estate. Now, commercial real estate is not equal across the board. There was a study that came out that I think the lease rates in the major metropolitan markets, the biggest cities across the country, are down 20%. And that equates to levels that we haven't seen since earlier financial crises back in the 80s and 90s. And actually are the highest we've seen since Moody's data only goes back to 1979, if I remember correctly. So that is a concern. I know in Michigan, Lansing is a concern because of things that are happening. But all commercial real estate is not equal. If you think about the work from home dynamic that has reshaped the environment coming out of the pandemic, you look at cities like New York and Chicago and such, and that it has been devastating. And as that all kind of comes to folks looking at refinancing or whatever, that's going to have a dramatic impact. I think Michigan, outside of Lansing, and I'll caveat Lansing, should be okay, because most of the commercial real estate across the state is typically owner occupied. It's the folks who operate their business and live, and the commercial real estate tied to that is often just a kind of an added comfort feature for the bank lending to those entities. So barring, I'm throwing a bunch of caveats out here, I guess, Sarah, but barring a dramatic economic downturn, I don't see it being as significant an impact in the state. Again, Lansing aside, that is on a personal level troubling. And my hope is that the state gets things in order, and we don't have a day of reckoning on that front. Any other?
I was trying, one more, asking how do you market the remaining bank stocks in Michigan and also get in younger shareholders to replace the aging shareholder population?
Okay, apparently there was another question about why I'm so damn charming and personable. No, Sarah was asking about marketing bank for a management team out touting their meeting with investors and bringing in. I think and it hasn't changed in 40 years. The best way to market your stock is to perform, and those that perform over time, it's going to be okay. We're going to have bumps, we're going to have ripples, but if you've got some good underlying fundamentals, irrespective of the market that you operate in, maybe low growth, no growth, whatever, you've got a good organization, well-run, nice historical track record, and expectations that folks can sleep easy at night with regard to the loan portfolio, you're going to be fine. I think it's really a function of just kind of getting out there. Everybody has a full-time day job, but being in front of investors and telling your story and working with folks in the community who should know you better than anybody, those are the ideal long-term investors. Because when there's, and I think, I can't speak to it because I didn't sit in that chair, but I know there's a few CEOs in the room at community banks. When last March hit, the feedback I was getting was that there were very few, CEOs, most of the CEOs in the state were proactive with regard to getting out to their larger deposit customers and talking about what was going on and trying to explain why Silicon Valley was not XYZ community bank here in Michigan. But the feedback I got, and I'll stand corrected if somebody says otherwise, was that there were very few inbound calls to those shops. And usually they were, hey, all this I'm hearing in California and New York, is that anything I need to worry about? I know you guys are fine and I'm good, but is that anything kind of a higher level I need to worry about? And that was it. And again, because those folks, you see them at the grocery store, you see them on the golf course, you see them at church, they know you, they know your operation. That's who you want longer term. So I think just, being out there and talking your story, never hurts, but performing, you gotta perform. So I think that, oh, I'm sorry, go ahead, Bill.
Real quick.
No economics questions,
No,
don't.
no, no, this is a question that I have a hard time answering myself, actually, but I'm getting a lot of questions from other advisors and clients regarding this year being an election year. Does that really mean anything to commercial bankers here in the Michigan markets?
Bill's question was, if I can paraphrase, does 2024 being an election year, particularly national election, have any kind of an impact with regard to the banks and how you run your shop and how you look at the landscape? And I think it creates a lot of, again, it's a personal opinion, because I don't really think I have a good answer to it. Mike might feel otherwise. I think it creates a lot of noise and distractions and such, but at the end of the day, your day-to-day operation, you try and cut through that and put it off to the side. I think typically you don't see any kind of dramatic policy moves coming out of DC in an election year for obvious reasons. So I don't see anything significant happening. The market
Tax rate staying the same, so on and so forth.
Yeah, market tends to like that kind of gridlock out of DC. I mean, there's the old adage about Washington does two things really well, nothing or overreact. And so we'll see. Hopefully it's more in the camp of doing nothing through 2024. But I don't think any banker loses sleep over it day to day. And tries to distance themselves from just
Yeah.
all the noise that comes out of it, which I thought it was crazy this past summer into the fall. Like I think I'm gonna go live on an island through the summer coming up, because I don't know if I can deal with it, but we'll see. Is that it?
Thanks, Mike.
All right, we're gonna take a break. We'll be back on at 11:15 sharp. And we will explore some of Bill's last question, because we've got people who are gonna talk about the political landscape coming up. So back here at 11:15 or back online at 11:15. Thanks.
We left.
We'll get started again in just a minute.
Okay.
Yeah, definitely reach out.
Oh, hey, I'm. I flew back here just to be here today, so. I'm good with that. Thank you.
The surprise away.
I'm sorry, well, I had a phone call, so.
We don't see crazy specials. I don't know.
Okay. Oh, thank you. Oh, yeah.
We're about to. We're not seeing any of the.
This one?
Wacky stuff.
Okay. Do I don't want to be in charge of that.
We're not seeing that.
Okay, we're gonna get going with the next segment, and we've got three great speakers in this segment. All of these things are gonna deal with political issues here in the state of Michigan. We're kicking it off with Marcia Hune. Marcia's one of the partners at GCSI, our lobbying firm. And then we'll hear from Kelly Cobb from the Mackinac Center for Public Policy. And then we'll hear from Stuart Bess, who is the chair of the Michigan Creditors Bar this year and is a partner with Waltman, Weinberg, and Reese. Anyway, we do a lot of work with Marcia. She is our eyes and ears in the Capitol. GCSI is everywhere in Michigan's capital. And there's a lot going on in Michigan this year. We hope that she's going to talk about the stalemate that we have right now. We hope the stalemate lasts as long as possible, and very little goes on during that period of time. But we are concerned about a lot of bills, and we'll go through all of those in detail. But Marcia has extensive political experience. She was in charge of government relations for another major financial services association prior to joining GCSI, so she knows our business. And she, like you, Sarah, can we flip this slide, is celebrating. She was at the national championship game with her husband and her son, and she was at the Rose Bowl for that game too. So I'm expecting an increase in our bills going forward. Anyway, with no further ado, please welcome Marcia Hune.
Thank you. Thank you for that introduction. I appreciate that. Well, that certainly was a bucket list item. I'm sure, as you can imagine, I was undergrad 26 years ago when we did go to the Rose Bowl and eventually won the national championship before the college playoff, system had ever been, created. And for a lot of different reasons, I was not able to make the trip to California that year. And since then have always regretted it and told myself, next time we go, I'm going. I don't care what it takes to get there. And for those of you that know my husband, he's really not into football, but clearly understands the stage that we were on for not only the Rose Bowl, but the national championship. So he was a wonderful trooper for me and my son. So we greatly appreciate that and happy to be back just in time for this update today. So as Mike mentioned, there is a lot that is going on in Lansing. It's kind of unprecedented times. And I feel though, like right before an election, whenever we've talked, with a lot of you folks, we've said that, but this is really, really unique. For those of you who may remember at the start of this session, Democrats have the trifecta, which is the first time in 40 years that they had not only the governor's seat, but both the House and the Senate. And they did so with very thin majorities because of the Independent Citizens Redistricting Commission that redrew the lines for this latest election. And, the House had come in with a 56-54 seat majority, and the Senate was 2018. Well, there were a couple of House Democrats that ran for local mayoral elections last November. They did prevail, and they have since resigned their seats, and now there is a 54-54, basically even Stevens, in the House right now. We will not call this, though, necessarily a majority for one or the other, or even I should say shared power, even though I know House Minority Leader Matt Hall would like to say that. But essentially, because of the way that the rules were written, unless there's essentially 55 seats that one party holds, they're not going to elect a new speaker. But just kind of a couple, things partially because of the elections, the local elections that those two House Democrats won last year. They had did an early adjournment back on November 14th, excuse me. And that's the first time in 55 years that they've adjourned sooner than December. And a lot of this is really inside baseball, but part of it is, there were a number of policies that the Democrats in the House and the Senate, and then the governor had obviously worked on, that were very partisan in nature, that were not able to receive immediate effect throughout the year. So according to our Constitution, those cannot take effect until 90 days after sine die, if the legislature does not grant them immediate effect. So that was another reason for them wanting to adjourn early. So a number of these policies could take effect now, mid-February this year, instead of waiting till, most likely end of March, if they waited till December to adjourn. And again, I mentioned also because of, the loss of the two House Democrats. They did return to session just this Wednesday. Again, mentioned that there were two Democrats in the House because of those elections that they won. And those special elections are slated to be held, the primary January 30th and then April 16th. So we are going to see now the House deadlocked at 54-54 between the Republicans and Democrats, at least until April. The two seats are heavily Democratic leaning, so we do expect that Democrats will again take those seats. But again, at least until April now, we're not going to have bodies in those seats. And I will just make the note too that the governor had made a couple of endorsements in those two seats for the primary. Both are women. One of them is the Macomb County Commissioner, and then the Westland City Council member in those two seats. So we will see if those two prevail, or if the governor's maybe going to have to make different endorsements after the primary. But it's kind of just an interesting dynamic right now, I think, with those. Again, I kind of briefly mentioned this, that there was a period of shared power back in the 93-94 session. But this year, there's not, a shared power agreement because of the 54-54 tie. Majority doesn't necessarily change just because of the loss of these two Democrats. And it's actually historically been written in the rules for a really long time that the election of a new speaker doesn't happen until one party, gets 50, or unless there's a 55-55 tie. So again, I know that, some of the Republicans are trying to take over, or take advantage of the narrative a little bit right now, which I think they need to be doing. To say, hey, it's shared power because we're even at 54. But again, the rules are not written as such. And so we're basically just going to likely see a stalemate, I think, for these next several months. We know that the speaker has indicated to his committee chairs that they should be active during this time. We likely will see a backlog of issues, that'll make it through committee, but probably, again, kind of a stalemate on the floor, and, backlog until, they can get up to full speed. The Senate is still at full strength right now, 2018 with the Democrats in majority. So we expect them to still operate, with business as usual regarding, their policies and their priorities. We, probably will see, like I said, probably fewer session days because of this tie and the backlog of the votes. But then, once those lawmakers are seated in April, we're going to quickly move into consideration of the fiscal year 25 budget. And there's always, really that race to try to finish that before the summer. And then, of course, because the House is up for election, they want to quickly get back into their districts, for these campaigns. And so we're going to see kind of a narrow window of opportunity, I think, between April and the summer of, consideration of some issues. And so maybe potentially a 2-month sprint to try to clear that backlog that happens over this first quarter. Now, this is, I think, probably what's kind of on top of everybody's mind right now. This was a ticking time bomb, I think, prior to the end of the year. And, this lawsuit, I feel like up until the ruling happened, there really wasn't a lot of attention that was paid to this. But there were some plaintiffs that were basically suing the Michigan Secretary of State and the Independent Citizens Redistricting Commission, challenging a number of Senate and House seats based on two kind of provisions. I think the one that you hear a lot about is the Voting Rights Act, and you hear the majority of minority districts, like, and think of Detroit, for example. In the past, when the legislature has looked at redistricting, they had taken kind of, this attitude of, keeping whole those districts and not diluting the votes by spreading them out. Whereas, detractors of that or opponents of that have said, what you did is you actually just packed those voters into Detroit, essentially, thereby, keeping them in one area and then, not allowing them to be in the surrounding areas. So that was one argument that the plaintiffs were making. Then there was also the racial gerrymandering in violation of the 14th Amendment of the Equal Protection Clause, because the plaintiffs said that those districts were drawn with race as the predominant consideration. And this is kind of important for those two provisions. So in late December, this is when the other shoe dropped, and the panel of 3 federal judges had ruled that those 13 state house and Senate districts did violate the constitutional rights of Black voters. And they did so not on the Voting Rights Act provision that they were trying to appeal on, but actually on the Equal Protection Clause, which, in talking with folks like Senate Minority Leader Eric Nesbitt, who's been watching this very closely, a lot of other redistricting cases around the country have really tended to focus only on the Voters' Rights Act and not this Equal Protection Clause, which was actually, I think, a higher hurdle, to try to overcome in this particular case, which is interesting. So again, there's 13 of these districts, 6 Senate and 7 House districts, all held by Democrats. And, the court had asked the parties to file the briefs by January 2nd, proposing how to fix the problem. And they just actually had this decision just the other day. And so this was what I was trying to update my notes. I apologize because everything's happening so quickly. But their ruling essentially was February 2nd is when they will have to draw the House maps. They have not done anything yet on the Senate maps. There was the Senate Democrats had filed an amicus brief to say that we don't want to have any special elections this year for the Senate. And essentially, I think the court has kind of agreed with that would create a lot of chaos. So no Senate elections anticipated for 2024, but the court has said that they would rule a little bit later on what exactly to do for those Senate districts. But they did deny the stay on the injunction from the defendants on this, that there couldn't be any elections, held during this time. So we are working with, again, that there's the deadline now of February 2nd, that they're going to have these new maps. I think just yesterday, the court had also just ruled that there's 2 special masters that are being appointed to assist in the redrawing of those 7 Detroit House seats. And then it's a March 29th deadline for the court's adoption of all of those final redrawn maps. So kind of just to run through this timeline really quickly, because I know, like I said, everything's kind of moving fast. Redistricting process for the deadline to draft February 2nd, after which a public comment period will be held no later than February 23rd and must include at least 1 hearing in Detroit. Final maps due no later than March 1st, followed by an objection response period until March 15th. And then again, the judges plan to approve the remedial House redistricting plan no later than March 29th. And all of these dates are really important because, we've obviously got an August primary and a November general election for the House of Representatives. And the filing deadline for those seats is April 23rd. So people need to know what seats they're obviously filing to run in. And there's just a lot of consternation, as you can imagine in Lansing, because people are not sure what districts they're going to run in. Are incumbents going to be drawn in with other incumbents? And how are these districts going to look? So it's an interesting dynamic right now in Lansing that not only do we have, the 54-54 split because of those 2 House Democrats that won local elections, but again, like I said, you've also got this other, time bomb that just went off on redistricting. So a lot of unknowns. My one understanding about the Supreme Court is that Justice Kavanaugh, I think just the other day, is looking at this, the appeal by the Independent Citizens Redistricting Commission. And I think that they are supposed to decide quickly whether or not they're going to, either dismiss or act on this case at the US Supreme Court level. Another example, though, that, we've been hearing from some insiders on this, because this was a 3-0 ruling by these federal judges, and because, again, it was the Equal Protection Clause and not necessarily the Voters' Rights Act that they ruled on, a lot of people are not sure, if the Supreme Court's wanting to try to take this up or even try to, delve into this. So, does that mean that they just dismiss this? And then again, we kind of run with that timeline that I just outlined. So I think a lot of this will shake out in the next week or two, but definitely, like I said, a lot of consternation in Lansing, and everybody's trying to figure out kind of what's going on. I'm not going to necessarily go into these because I know we've got some speakers coming up later. But I think one of the things, as Mike had kind of mentioned in the intro, is that not only I think does the stalemate with the 54-54 House, and also, the concerns with what is going to shake out with redistricting. There's a lot of bills that we have been watching that are of concern, and that might be better for us because I just don't know if the legislature is going to want to take up anything that's so controversial during this time as they're trying to kind of wade through a lot of, the other stuff that's going on right now. And again, I know, like I said, Stuart in particular on the garnishment legislation will be talking about that particular piece. And then just, a couple of things with the election preview, until we obviously know what the House maps are going to look like. At this point in time, we do know that all 110 state House seats will be up. And this, of course, is the Republicans, first opportunity to take back at least one chamber in state government. Again, the state Senate is not up for election this cycle. And according, like I said, to, the judges, they have ruled that there aren't going to be necessarily special elections for them. Of course, U.S. Senator Stabenow has announced, she's retiring. Handful of people that are running, on both sides. And so it'll be interesting to see how both the Republican and Democratic primaries shake out for that particular race. The 7th congressional seat with U.S. Rep. Alyssa Slotkin running for the U.S. Senate seat that Stabenow is vacating. Her seat is open. And you really got, a rematch between former state Senator Curtis Hertel and former state Senator Tom Barrett in that particular race. And I'm sure any of you around this area have probably been getting a lot of email updates from either campaign or both campaigns maybe. And I think that that's going to be another barn burner, as that's definitely, considered a swing seat. I think the other one that a lot of eyes are on right now too is, of course, U.S. Rep. Dan Kildee had announced his retirement and that he's not running for re-election. This is definitely a swing seat as well, only 52% Dem leaning. And Paul Young on the Republican side is running again. He ran against Congressman Kildee last election. But the one that was, people were kind of unsure, but then, just I think in December, she had announced, State Senator Kristen McDonald-Rivers had announced, that was a seat that the Democrats narrowly took, helped them get majority. And again, remember, they've only got a 2018 majority in that particular body. So obviously, if she wins, what does that mean for the state Senate? It'll be interesting times. So there's kind of some conventional wisdom that the governor may slow walk that special election because, at this point, it would be really difficult if a Republican obviously took that one over, like I said, because that was such a close election last time between Republicans and Democrats, and depending on who runs, on the Republican side, it's unsure. But State Representative Bill Schuette, when I had sent my slides, last week, he had a big announcement that he was going to be making. At the end of the day, what he said was that he's running for re-election in the state house and not for Congress. So at this point, pretty much Paul Young, like I said, is the Republican, who's really eyeing this, and we'll see who else kind of comes out of the woodwork. Of course, we're continuing to hear challenges possibly to Congressman Tanadar and U.S. Rep. Tlaib as well too. So lots going on in those. And I know that we were kind of leaving a little bit of time for questions before we move to the next speaker. So does anybody have anything that they wanted to cover? Yeah, Andy, I figured you might have some.
Yeah, two quick ones. One is,
Yeah.
what was it? This co-speakership with, what's his name? Hertel. and,
Yeah, Hilligan.
Hilligan.
Mhm. Yeah.
I feel like a lot of times that's thought of as kind of a golden age.
Right.
For government in Michigan. Are your colleagues talking about that, kind of hoping for that come back? And then second, can you comment on the latest polling data on that Senate race, which came in a lot tighter? I don't know if you saw those numbers than I would have expected, but.
For the U.S. Senate?
Slot.
Oh, no, I hadn't necessarily seen that. Well, let's talk about that one really quick first. What were the numbers? I hadn't seen it just yet.
pretty
Is-
even.
Okay, Yep.
I think Slotkin, I think, was down 2 to the
Okay.
police chief
okay.
and a lot more competitive than I will be.
And that probably makes sense because I did see that Mike Rogers had just endorsed Trump. And so I wonder if that's why he's trying to get that bump then maybe over Craig to try to see, because obviously he's got to win the primary first, before he can have a chance to take her on. So I guess that makes sense. And maybe that's just a faction of again, I think we're seeing some, high numbers again for, former President Trump. And then on the flip side, though, on the Democratic side, there's a lot of people that are saying that they would prefer Governor Whitmer, obviously, over, President Biden. So, maybe that's just a lot of the consternation, that's going on in the state. And yeah, interesting. We'll continue to watch those, but I'm assuming that's why a lot of this stuff is playing out right now. But yeah, kind of to your question about the shared power, that was just before my time here. So unfortunately, I didn't get to actually work through that, but my first boss, Bev Hammerstrom, spoke very fondly of that time because she said we obviously had to work together because the chairmanships of the committees would switch each month, so you could try to push your agenda through 1 month, but then, it was going to go nowhere the next month. So they had to work together. And I think that that's the narrative, like I said, that the Republicans, I think, are trying to kind of paint that they're saying, hey, it's 54-54. We're even here and we want it. We're ready and we're willing to work in a bipartisan manner. Why won't you just do this? Why won't you do like a co-speakership? But again, I mean, it's not, I think, realistic, again, given that we know that they're two solidly Democratic seats, like I said, in a couple more months, they're going to get those back and they'll be up at full strength, albeit it'll be a thin margin again, only 56-54. But I think that that's kind of the narrative that it's like, we still have, some Dem priorities that we want to try to get done and we're ready and willing to work on those when we get back to 56. So, but in the meantime, I know the speaker has said, Minority Leader Hall, what is it that you want to work on in a bipartisan fashion? Let's definitely take these next 4 months and see what we can, work across the aisle on. So it's just a matter of, like I said, if it's all for show or if they're actually going to try to do it. So
Thank you.
Yeah.
Good work is up.
yeah, thank you. Any other questions?
All right, thanks. Marty.
Yeah, thank you. Thanks so much for having me here. Appreciate it.
GCSI has been the #1 lobbying firm in the state of Michigan. They've been the #1 lobbying firm in the state of Michigan for over 15 years, and we're really lucky to have them. We're going to talk about the Renters Bill of Rights next, and I'm going to introduce Kelly Cobb from the Mackinac Center, but I want to tell you a little bit about how that rolled out and why our relationship with them is so important. So in August, Marcia had me meet with Emily Diefendorf, who is one of the primary sponsors of this Renters Bill of Rights. So we had it went about an hour conference call. I got a chance to read all the parts of the various bills they were going to have. And then, Emily went through it. She was very nice, very personable, and said, Mike, you can comment about these things as we go. We ended the thing, never gave me a chance to comment. I was biting my tongue the whole time, like, there's nothing in here that I like. But what that gave us, we met in August with her before she ever even introduced the bills. So I knew about it. I knew it was coming. I got out my old Rolodex from my banking days. And I'm calling the major real estate players in this state. I won't name them all, but I called Warren Rose. He's on one of our bank boards. He is the CEO of Edward Rose and Sons. Not only are they huge in this state, but they're one of the top 5 apartment owners in America, not just Michigan. I called Gary Shipman at Sun Communities. Gary is the largest mobile home park owner in America. He's one of the biggest marina owners in America. And then I called a whole bunch of other key real estate people. Rick McGirt from Isabel Bank, who has the most apartments in Mount Pleasant. Anyway, we got that whole real estate group going to try to join us in financial services to fight this. And one of the people that really started pulling things together is Kelly Cobb. Kelly pulled a lot of the top real estate people in Metro Detroit together at a meeting in Bloomfield Hills. When was it?
Yeah, probably October. And I was invited on the financial services side, and then that was the impetus to form a coalition to fight this thing and to fight these rules. These renters' bill of rights bills passed in Minnesota. They have the exact same legislative makeup that we have. A 2-seat majority in the Senate, a couple seat majority in the House. So we have to take this really seriously. And there's not a better group in Michigan to fight this than the Mackinac Center for Public Policy and the Mackinac Center for Action. And there isn't a much better guy to fight this. I didn't know Kelly before we had that meeting, but I was so impressed by his knowledge of the state, how you get things done in the state. So we were thrilled. I asked him if he'd come and speak to all of our bankers. We're thrilled to have him here today. He has a lot of experience. He was with the Cato Institute in a major role. He's a 3rd-generation business owner of the Hunter House Hamburgers, right, in Birmingham, which is a great place that's been there for a long time. But anyway, please welcome Kelly Kopp.
Thanks, everybody. So that was very flattering, too flattering introduction. Kelly Kopp, for those who don't know the Mackinac Center, I'm the senior strategist there. I do a lot of different things, as he said, but this is the role that I love the most in my life, aside from my 4 kids. We are the state's free market think tank and advocacy group, nonprofit. So we have a C3 and a C4 component. Our C4 component does public policy advocacy and education. C3 does a lot of research work. We've been around for about 37 years now. We're very laser focused on this issue. We consider the Renters' Bill of Rights to be probably one of the most likely things to pass and one of the most anti-free market things to pass in the state if things keep moving forward this year. So I want to walk through it as quickly as I can for you and give you a sense, but we've started what we're calling the Safe and Affordable Housing Campaign. We have a narrative out here of Renters' Bill of Rights. Who's opposed to that, right? Who's opposed to that? The problem is that all these bills would make housing less affordable, less plentiful, less safe. And so we want to counter that with a narrative that free market ideas like zoning reform, like, parking mandates in downtown areas, licensing issues, if we could reform those, we could actually increase the supply of housing and keep the cost of rent low. And so that's why we chose the name and built the coalition that we did. So there's 179 housing bills in the state of Michigan right now that have been introduced, but about a dozen of them pertain to the Renters' Bill of Rights. And I'm going to tick through them right now really quick. Permit local governments to enact rent control. I think San Francisco's been in the news enough recently. I don't need to explain that one. Stop the use of credit ratings for renters. You don't know how worthy your renter is. Forbid consideration of a renter's source of income. So this is an interesting one because it's the only one that's passed right now. It's passed the Senate and it passed out of nowhere in October. Didn't see it coming. And it de facto, some landlords don't care about this. Some really do. It de facto forces you, if a renter comes up with a Section 8 housing certificate, you've got to take it, or you got to take the renter anyway. So it forces you into the Section 8 housing, with enormous administrative costs and a headache for a lot of landlords, which is why it's such a concern. Forbids the use of criminal background checks. I had one landlord I was talking to who just said simply, if someone has committed arson, I need to know about that. It's pretty basic stuff. Limit the ability of landlords and other creditors to recoup money. Stuart's going to talk about that one. I don't need to touch on that one. That's the garnishment stuff. Require landlords to accept renters on a first come, first served basis. But wait, there's more. Taxpayer funded legal services for lawsuits. You can imagine that this one was put in by the lawyers, trial lawyers, union, because they would be able to file a number of frivolous lawsuits. Landlords pay relocation assistance. This one's not terribly controversial, but it's being pushed. The right of first refusal for tenants or a tenants association if a price offer is at least as favorable as other offers or at least the appraised value. So a tenants union can be formed and they can compete with you on who's going to buy the property. Under consideration, these haven't been introduced, but they are on paper from Representative Devendorf. renter's agency for repairs, so renters can just basically make the repairs and send the bill to the landlord. Surprise building inspections.
No fraud in that, will there?
No, not at all, not at all.
You'll have gold plated, faucets going in.
Right.
But you gotta pay.
I got a number of paper receipts from Office Max I can give you. Rights to establish tenants unions, and then they just start picking kind of around the edges. So you can imagine this kind of falls into cultural issues right now, but landlord license, in order to get a license, if you're a landlord, you got to take a class on the cause of homelessness, the impact on eviction, as though people don't have a heart in this industry as it is. And they do. And I've talked to a number of landlords, and some of them say, I used to create special programs where I'd hire a potential renter, put them into one of my low-income housing. I'd hire them in another retail establishment I have to get them on their feet again. People in this industry are being made out as though they don't have a heart, as though they have billions of dollars and don't care about people in general. And it's simply not true. And we're pushing we're pushing against that narrative because we want people to understand that these are people too. And a lot of them are just small business owners who, if you're not paying your rent, they're not paying their own mortgage for their own family. So these are basically the bills that are put together. And if you kind of do the math on it, it adds up to, you don't know if the person can pay. You might have to take an application, and the first person who submits it, you got to take that one. You don't know if they're credit worthy. You don't know if they can afford the building. You don't know if they just got out of jail for committing arson, and you've got to put them in your community. And a lot of landlords look at this and say, across the board, this is not something that's tenable and it's not going to work. This is what we've heard. These are direct quotes. I've spoken to dozens of landlords across the state of Michigan. Once we started this, they started coming to me, and these are just some quotes that I've received. And I think the second one is probably the one that speaks the most to me. There's two parts of that. They're not going to have enough money to maintain their properties. So this is such a cost that their profit margin goes down so much they can't even maintain and reinvest in the property. And two, they won't even have enough money to put into new properties. Governor wants 70,000 new housing units by 2030. How do we get there if you can't even maintain properties, let alone build new ones? It's not possible. This is not going to solve the housing issue in Michigan. So really quick on the politics, Marcia did a great job. I'm not gonna repeat everything, but committees are still gonna work. There's a tie in the House. Then we get budget season going. That's going to kind of, muffle things up. July to October, they're back to normalcy. They got two Democrats in Westland and Warren. They might be taking some campaign vacations, doing some parades and so on and so forth. I've heard two arguments of why we shouldn't be concerned about the Renters' Bill of Rights, or really anything much this year. And they are the following. One, the Whitmer administration and House leadership have told people that this is not really on the radar. They're not very concerned about it right now. Okay. Well, of course they're going to say that regardless. This is a Biden administration priority. This is coming out of the National Democratic Party. This is coming out of progressive planks outside of the whole country. Mentioned Minnesota. This is a nationwide effort. If it comes to Whitmer's desk, she's going to sign it. She's running for president, in case anyone didn't know that already. And House leadership is going to say that too, because they can't afford to lose fragile seats in the fall. They don't necessarily want this to go forward, but they can't afford to lose those seats in the fall election. And so they're not pushing controversial stuff. They want everyone to go home, campaign, and be happy so they can keep those seats. But I'll get to the second thing that is I've heard too, and that's that, well, there's a tie and they've got a vacation and they've got an election and everything else. This is what I'm concerned about. Lame duck. There is a very strong chance that Republicans take the House this year. They're out fundraising. There's 4 House seats. They're held less than 1,000 votes. I think one of them was or 2 of them under 400 votes out of 20,000 votes in a district. Lame duck is when all bets are off the table. There's no consequences for votes in lame duck. And for 40 years, Republicans held. Now, for 40 years, Democrats have waited. And if they've only got 2 years to get done what they want to get done, and they just got voted out, and so one of the 3 places, the House, is no longer theirs in January, you better believe they're going to get done every other thing they want to do before they leave. Now, how do they do it? That's the other question. This is what scares us. And by the way, if there's any other issues that you're concerned about, bloodbath. We're talking minimum wage, we're talking progressive income tax, we're talking about a number of other things could come up in the lame duck. We expect it. We are expecting it at Mackinac Center. This is the other thing is they've said, well, we're not going to bring these up. This is Emily Devendorf. Devendorf is the vice chair of the housing committee. She's the main pusher of this bill package. And you'll note what she's saying, what Devendorf is saying here is, I think people should hold their votes to make sure we are creating public policy that helps everyone. The read on that is, if the House leadership wants something passed, we're as progressives, which is a large block, we're not going to allow it to come to the floor until we get what we want passed. Now, progressives have had a number of wins in Michigan, but they have predominantly been on social issues, abortion, culture issues. They've had one real win on the economic side of the ledger, and that's right to work, which is absolutely devastating. We were behind the whole right to work campaign since the mid-90s at Mackinac Center, so that hit us pretty hard. They haven't gotten a lot of other economic progressive priority wins yet, and this is at the top of the radar. And this is the package sponsor saying what they're going to do. So that's why we're concerned about it. We put together a campaign. I'll go through it relatively quickly. Short term, we want to defeat or water down some of these bills the best we can. There's great lobbyists from a number of associations who are working on this in the state already. We're working on it from a messaging and narrative campaign, as well as with our, I'll walk through it all with you, but with our Lansing folks. But long term, we want to create an offensive campaign for positive free market reforms in housing. There was an interesting story. If anyone reads Axios Markets yesterday, Axios is a national publication in the markets column. It was all about rent and how rent has gone up as a percentage of income. And they did a poll and why it's making life terrible for everybody. And I sympathize with that. I'm not a renter, but I sympathize with that. And then you get to the fourth story and it's, well, there's one exception to the rule, and that's oddly Minneapolis. In Minneapolis, here's what they did, and this is why rent hasn't increased beyond inflation. Well, they did zoning reform. They allowed builders to build. They took away parking mandates in the downtown core for residential parking. They did free market policy, and there's a supply of housing and rent's not going up. It's basic supply and demand, right? So we want to change the narrative and the perception of landlords of being these evil people that need all these restrictions put on them, and turn it around to, look, if we put in place really good reforms, that's what benefits renters. I'm here because I'm standing on the side of renters. They may or may not know it, but I'm standing on the side of renters. We want renters to have safe and affordable housing. And so that's why we're pushing for free market reforms to shift the narrative. Briefly, our campaign goals, they speak to all the core competencies of the Mackinac Center. We have a number of different areas and departments in our organization, but we predominantly reformed on research. We want to be able to show how destructive the bills are. We can point to in a lot of quantitative analysis and basic examples like San Francisco, we can point to what these bills are all going to do, examine the roles of regulations, and outline reforms that we would propose as an alternative. Our marketing and comms team is huge and growing. We just built out a whole new center to focus on marketing and comms called the Frank Beckman Center for Journalism. But what we've done so far, so for example, in the bottom left corner, you see a little video. It's a darker thing. That was a video. We put together 2 videos with 2 small kind of burst strategy guys. They do flip houses and stuff about the Renters Bill of Rights. That one video alone has over 250,000 views on social media already. So we want to push a narrative out with video content. We held a panel just across the street at our office from the Capitol on zoning reform and free market ideas. And then actually Emily Devendorf and a few other members of the legislature on the Housing Committee attended that. So that was great. And we've published a number of op-eds and so forth. But then we want to take these videos and we want to put them into ads and geographically target them through our C4 into select areas in the state where we think the message really needs to be pushed the strongest about these bills. So that's on the marketing and comms front. Legislative, There's a number of great lobbyists in the state, March is one of them that are working on this issue. We also have government affairs, this is actually our government affairs office right here, and the Capitol across the street, where we're working out of there against these bills as well. So we'll do all the things that one would normally do. Then we think that all this is necessary, but maybe not sufficient. And this is where the campaign narrative really comes in. We want to use our C4 to be able to push a grassroots education campaign about what these bills are going to do, which is destroy the housing industry, the real estate industry, and spill over completely into your industry. We put a plan together to reach as many as 75,000 households with direct mail, 125,000 constituents with digital ads. Those are click to email your lawmaker type stuff, push that message back to the Capitol, right? And the benefit of the way that we can do this is, one, we have a list of tens of thousands of people in Michigan that are very big supporters of ours, which is obvious that they'll take action, have a high amount of engagement with them. We also have a list of about 8.5 million homes in Michigan that we can sort through, qualified voters, that we can sort through demographically. So we can say, give me a house district over here that might be a little contentious. We want to target all the renters, filter those people in, and we want it to be a certain breakdown in maybe political leanings or how they might feel about certain issues. And then we've got a list of people right there that we can send mail directly to inform them about the issue. So we're thinking a very agile and very targeted approach to making sure that people understand what this will do to the state. If all this fails, we also have the Mackinac Center Legal Foundation. We file lawsuits against the state all the time. Our legal foundation won the lawsuit on why COVID restrictions were unconstitutional. So that'll never happen again in Michigan because of the legal foundation. So we could use the legal foundation on a number of fronts should the bills pass to challenge certain parts of them and so on and so forth. And then we're building a coalition. I talk to people every single day to try and pull people into this group. Bankers and the community bankers and Mike have been absolutely wonderful to us, helping connect people. We feel that your industry is under a real direct threat here because of a lot of the money and the financing for housing. Obviously, you know better than me, rolls through all of you. And our concern is that this is going to have a huge ripple effect, not just for landlords, not just for real estate prices, not just for renters having their rent go up when all of this passes, but ultimately also in the financial industry. We think that ripple effect is going to be quite strong. So happy to take any questions. My contact information and Mike was great to put together something to hand out to you too if you want to reach out as well.
Any questions from anyone in the audience?
I guess I was comprehensive.
Great. Thank you, Kelly.
Thanks, Mike. Appreciate
it. Just a couple of comments on this topic. So first of all, I want to be clear. There is a serious shortage of low to moderate income housing in Michigan. That's a fact. It's a fact all across America, not just in Michigan. So the way we want to kind of come at this is, we just don't think this is the way to solve it. We agree there's the problem. I think the way to solve it is to get the folks in the real estate industry and all of us in financial services to come together with the state, try to figure out how we can do more low to moderate income housing projects. And it'll probably require some incentives to do that. But we just think this is the absolute, we agree with the, the basic thing they're trying to accomplish. Let's try to make things a little more affordable. Why did rent get so expensive? Inflation, big part of it that drove up rental expenses. What you may or may not know is during COVID, there was a moratorium on being able to evict tenants. So landlords couldn't get rid of a tenant. And now the courts are clogged, right? Because now there was 2 years where they couldn't get a tenant out. Now they've got all these tenants they have to get out. But those tenants have been there for 2 years not paying those landlords, which then caused the rent to go up on everybody else, right? Because all these people weren't paying, but they were still there. Landlord couldn't get somebody else in. So I didn't know this until I was at the meeting with Kelly, but the profit margin nationally for multifamily homeowners is 8 cents on the dollar. I mean, they're not, they're, hey, we make 1%. They're making 8, but they can only lever like 3.5 times. You can lever your bank 10 to 12 times. So the return on equity is not that much. It's a little higher than ours. It's probably, 20 to 25%, but it's not that far off of our industry, and it hasn't been that good the last couple of years. So what I would ask all the bankers in the room to consider, we have a form that we've given to everybody in the room and we're going to send to everybody out there. The CBM's made a contribution to the coalition on behalf of all the banks in the state. So we joined the coalition, our board approved it, and we made a financial contribution. But we need to raise about $1 million to do this right. Most of that money has to come from the apartment industry and the mobile home industry here in Michigan. But we put a guideline in here for banks by asset size. If you are inclined to contribute, we'd love to see you join it. You would just make the contribution directly to Kelly and the Mackinac Center. It's not coming through the CBM. We're not touching it. And it's not a PAC contribution. So, they have a 501c4, so you can make a corporate contribution through your bank to do it. So it's a little different animal that way. And anyway, really appreciate having Kelly here today. This will be something we have to work on all year. And there's a couple other bills that we're very concerned about, and it also ties into the real estate industry, and those are the garnishment and bankruptcy bills. I know I put a lot out on those bills, and so you're all familiar with them. But one of the guys leading the charge has been Stuart Best, and he's worked with us and the other financial institutions. I loosened this thing, so now it's going to be a problem. Of course. Anyway, and Stuart's been great. He's been in meetings with us at the Capitol. He's been a great source of information on details having to do with the bankruptcy statutes and the garnishment statutes. But I will just tell you, we fought really hard to make sure that the banks don't get stuck in the middle of this whole garnishment thing. We don't want to be the ones that have to figure things out, and we don't want to have any liability over it. But if these things were to pass, we're hoping we can modify them to something that all creditors can live with. But if we can't and they pass in their current form, it's going to be really difficult to ever collect on another loan in the state of Michigan, particularly on anybody who's like under $120,000 in income. But we're delighted to have Stuart Best here, like I said, the chair of the Michigan Creditors Bar this year, and an expert in all things garnishment and bankruptcy. Wow.
Thank you. So let's begin. For those of you that don't know me, let me give you 30 seconds of myself and why you're listening to me and why you're going to understand what we're talking about. First of all, I'm a shareholder with Weltman Weinberg and Reese. We are the largest collection firm in the United States. This is what we do. We are not a law firm that happens to also do collections. It does personal injury, et cetera. This is our focus. The banking industry is our industry. We are here, we work with you guys, and we're looking out for your best interest. About a year ago, a little less than a year ago, I got this, I'm on the board of directors at the time for the Michigan Creditors Bar Association. And those of you that have been on nonprofits before have ever heard the term voluntold. So I'm on this meeting and they make the quick announcement that, hey, by the way, the current president is retiring and everybody that wants to take that position, please step up. And everybody else steps back, and I was not fast enough on the switch. Fine, no big deal. That's great, my world. I'm fine with that. So I get in, I spend a few minutes in there, and about the second month in, my government affairs committee comes on to our meeting and says, oh my gosh, we got a problem. We have a huge problem coming down the pike. We have 408, 409, and 4900. I'm like, okay, what is this? We go through these and I'll explain the bills in just a moment to you, but I'm gonna, if you don't leave here and have a little pit in your stomach eating lunch, I apologize, but that's what I'm here for, okay? A couple of the presentations I've made in the past, I've walked out and people shake my hand and go, thank you for telling us the truth, yet you just ruined my lunch. That's my life. We jump in, we start looking at these bills, and the second phone call I made after having a board discussion was to Mike Turney. Mike, I'm sending you some stuff. Let's get your lobbyist out, get this up on the list. Made a few other phone calls and started putting together a group because we got some problems. Don't think that this stuff isn't coming around. There is the Pew Charitable Trust that's supporting these. Millions of dollars have been dumped into supporting these bills behind the scenes. These and a few other bills. This already happened in Arizona. They woke up one morning and found out that what I'm going to show you in a minute, which is actually worse in Arizona, happened. And literally they woke up one morning and said, what happened? It was a lame duck session, et cetera. I'm not a politician. I don't get into politics. That's what we let Marcia and those folks deal with. But this stuff came and it hit hard. 3 other states are challenging these exact same things right now. And there is millions behind this. Why? We don't understand. I mean, they're trying a pendulum swing that is so far bad that it's like, I can't even imagine. And you'll understand that when I get to this in a minute. These 2 bills that are out there basically are eliminating our ability to collect debt. To be blunt, I'll be very basic about that. Senator Irwin is one of the ones that's proposing this legislation. As soon as we heard the bills got up, we spent some time with Senator Irwin. I went right into his office, the Michigan Creditors Bar. We got in there, 4 of us sat down. Time he had a problem with his leg, so he comes wheeling into his office in his wheelchair. Before he breaks the door, he says, wow, I'm walking into a den of wolves. And because it was the Michigan Creditors Bar, he knew that this was going to be horrid and it was going to be an ugly discussion. Well, we turned that around, obviously, and we also changed the mantra as well. We're here to help, right? So we started working on these a little bit. The most important question I had for him during that whole session was, why? What are we doing? And if you don't know Senator Irwin, I see some shaking heads, et cetera. I'm not going to get into his politics, et cetera. But his response was, we're trying to protect the poor debtor. And I said, well, wait a minute, Senator. Let's separate those 2 words. Poor and debtor are 2 different people. I'm not going to go after an 85-year-old lady on Social Security who's got a $30,000 credit card bill, her house is fully mortgaged. What's my point? That's not what the bankers want to do either. That's not the intent here. But the guy making $65,000 to, as Mike's calculations, depending on how you work this, up to $120,000 individually. This is not household income. I cannot collect. I cannot garnish. I cannot garnish wages. You cannot offset funds in your bank up to $17,000 of cash that they have. You can't touch it under these bills. Are you getting nervous? Now, think about this for a minute. The community banks, most of us are here are community bankers, right? What's your average depositor's income? What's your average depositor's income? 80,000, 100,000? Guess what? Your average depositor, when you give them a credit card and or you make them a loan based on these statutes, if they don't pay, you can't collect that money back. Blunt, unless they decide to pay it back to you. Poor and debtor are 2 different people. Now, this flies in the face of Mike's comment a few moments ago. Look at net charge-offs for the lowest that we've been in years, and I understand all that. But that's the time when they want to slide these kind of bills in. When you guys say, my charge-offs are low, I'm not worried about collecting money, I'm good. I've talked to almost every banker in this room. We all know where you guys are at. You're sitting pretty right now. 2008, we forget that. Okay, when you're banging down my door to try to get my time to get your money back for you. Okay, so be aware this is a problem. So bottom line, requiring us to notify a debtor, by the way, 15 days before we issue a writ of garnishment. That's not a wage garnishment, that's a bank garnishment. Okay, so your debtor is sitting there. I'm going to try to garnish them if we can actually get a garnishment out there. And I got to tell them I'm coming. Seriously? I'm going to clean the account out. Move it to another bank. Can't get it. Move it to another bank. They're going to fall under the restrictions. Okay, if in fact, in these numbers, actually, we've been playing back and forth with the $72,000 exemption, you can make up to 72. This is actually, Mike's right. It's more than we just got recalculated again. It's upwards of a $90,000 to $100,000 of income, individual income. So in other words, your borrower can have 70,000 in income, but the wife can make it 150. Guess what? Can't garnish. $25,000 exemption for a vehicle and $15,000 for other vehicles. We've actually done the calculations on this and they could keep upwards of multiple vehicles. It's not saying your commercial vehicle is exempt, which it currently is under the statute. They get to exempt all their vehicles basically up to $25,000. Okay, it's not the greatest car in the world, but it ain't so bad. Okay, but that's an exempt asset. Now, typically most of the time those are exempt because there's already a lien out there against that vehicle, yet that's not what we're looking at. We're looking at the 3 and 4 other vehicles. If they're smart and they start looking at a debt issue and they've got cash, they're gonna dump them into exempt assets. They're gonna go out there and buy a bunch of cars, can't touch them. Our court officers are flipping out because that's one of the areas that we go and collect from people. When you go up and you hook onto the car, forget what you see on TV, that's all a joke. But they go up and hook onto their car and take it away from them, they wake up and they get a hold of you. They go, hey, let's work this out. We typically give them the car back, but it wakes them up and gives them that opportunity to talk to us, gives them the opportunity. We have something that can go on. It eliminates our state tax garnability. We filed 40,000 tax garnishments last year for you folks, for the bankers in the state of Michigan. Our return on it is substantial. If we lose that, you're going to lose money and getting that money back. Someone's going to get a state tax garnishment. Of course, what are they going to do if they're having issues? They do have income. They're going to stash it into their state tax refund and we can't touch it. Now comes the real fun part. Let's say your bank says, I'm not going to issue garnishments anymore, so I'm not going to worry about this. I'm going to take other ways of collecting it. The other banks that are, by the way, you, as a receiving bank of a garnishment of one of your debtors, you've got a huge obligation under this statute. You've got to do reviews. You have to do look backs. You have to make sure that this asset that you have is an exempt or not exempt asset. And that's on you. That's not on the bank garnishing. That's not on the debtor. Senator Irwin, and I hate to quote, but I'm going to quote, he wants an automatic backstop. His words. The debtor has to do nothing. Absolutely nothing. It's on you as the banker to deal with this stuff. You have to put in policies and procedures to review this. And guess what? It's a strict liability statute. You screw up, $2,000 hit plus actual legal fees. Now, if you haven't had a suit by those folks in the cottage industry that love to sue banks, they can add legal fees faster than you and I can add up interest. Okay? Current Michigan law, and these are slides you can take a look at. We had an agreement. We had a group that put together called the Justice for All Committee. This was a committee combined of a bunch of different, both sides of the world here, debtors, consumer attorneys, us, the district court judges. They came up with something that's relatively reasonable, and you can do all the math if you want. I put this slide up here to show you in a minute that basically even Justice for All said, okay, fine, let's adjust some of these numbers. Let's get a middle ground in place. So a hit of a garnishment, basically under this statute 408, which is what Senator Irwin and his group is proposing, we're going to get 0 on garnishments. Bottom line, they're eliminating our right to garnish wages and or income and or the bank accounts. And again, don't forget this, it also stops your ability to offset. So you could have a debtor that owes you up to $17,000 or more, makes less than $100,000, has $17,000 in cash in your bank, and they owe you money, you cannot offset it. Okay? Where is this coming from? 18-month look back, a secondary look back that you have to take to make sure that, again, there's nothing in here. And again, first in, first out rules. You guys understand that, but just think about trying to write a policy on this for your bank and hoping you don't get hit. Okay, talk about regulation. This one could get you guys in serious trouble and you don't even see it coming because it's not your garnishment. You didn't start this world. You simply have a bank account with this individual. The financial institution, you guys, as the recipient of this garnishment, shall not charge a debtor a fee for any actions taken by the financial institution in connection with the garnishment. Your bank gets hit by a garnishment for a debtor or for a depositor of yours. You didn't initiate this. You've got to do all that risk, take on all that risk, potentially get hit with $2,000 plus actual legal fees if you screw it up after you spent all this time putting the policies and procedures together to make sure you get it right. You can't charge for that. Strict liability. You screw up, you're going to get hit. Absolutely. You're going to get charged. You can show what we call the bona fide error rule. This is what we use under the FDCPA, which is a bona fide error rule. But again, now you got to hire yourself an attorney. You got to go in to defend this thing, and you got to prove that we really had policies and procedure in place. Of course, the next 5 years, everybody's going to challenge that those are right, wrong, or indifferent. Who knows what the policy is? We'll figure that out. And then you've got to prove that you did it right. 409 is a little bit different. 409 is saying we're exempting the homes. We're taking the homestead exemption up. Currently, it's fairly low. It's about 3,000 to 4,000. But if you play games in the bankruptcy world, I'm not a bankruptcy attorney. I just play one on TV. And if you shift things around, you can exempt pretty much most of the equity in your home. This is going to take it between $250,000 and $350,000 of exempt. If you don't know the game, okay, and this happened, I'm going to give you a quick real world example. We go after, one of my banks had an issue with a contractor. Contractor walked away with, I don't know, millions of dollars after stiffing a bunch of people. So what does he do? Well, as he starts to find out we're coming after him, where does he go? He moves to Florida. What does he do in Florida? Builds a massive home in Florida. Why? Because when you file bankruptcy in Florida, 100% of your homestead is exempt. He had zero cash when we went after him in Florida. It's all in his house. He files bankruptcy. 100% exempt. Can't touch it. They're getting there in Michigan. 2 years ago, I had a discussion with a senator and said, hey, whoa, wait a minute. I got wind of the fact they had questions about how we're going to do the exemptions. They want to fix the exemptions. This was 2 years ago. They started this. And they started talking about this. So I put my bankruptcy folks on them and said, hey, hold on. You start raising these exemptions. Guess what this does? This doesn't only hurt the bank from the mortgage side. Forget that for a second. What it does is it hurts the unsecureds now. Because all this is exempt, when you go through bankruptcy, the unsecured debtors, creditors rather, take the hit. So this looks innocuous as, oh, we got to make sure we're not kicking people out of their houses. We're not taking their homes away. That's not what this is doing. It's shifting that burden to the unsecured lenders. So your credit card debt is not exempt, and it's going to take the hit because of your exemptions. Made you a nice little list. These are the folks. Okay, these are the folks we've been talking to. These are the folks that are backing these bills. These are the folks that we are asking to go talk to yourselves. Okay, this list is in the PowerPoint. I don't need to go through it. And this is 409's list. Now, Brenda Carter has been a help. We spent some time with Brenda Carter. We're working with her because we said, look, 409, which is the exemption bill, the one thing that we want to do, well, let me back up for a second. We as well have been building a coalition. Soon as I got the phone call off to Mike, he got my email. We started talking about this over a year ago. We, as the Michigan Creditors Bar, along with CBM, said, look, we are going to need help. So let's put a coalition together. So we started building this coalition. We've got a group going together. We've got a statewide coalition as well as a national coalition. Let me back up and kind of tell you the mantras of what they're looking at. Okay. What's really going on here, the way this was pushed to these legislatures. In fact, when I talked to a few of them, they said, oh, that garnishment thing, all we want to do is make sure that we don't hit the earned income tax credit. Excuse me? That's not what the bill says. Did you read it? We're on board with the fact that we don't want to garnish the earned income tax credit. The state's giving people money. We don't want to utilize that. We want to make sure they can live off that. Fine, we'll exempt it. It's easy. Even the state has said, we can code this, we can figure it out, we can exempt the earned income tax credit. That's what they sold a bunch of these legislators on. saying, hey, we want to protect the state money that we're giving them or federal monies that are coming out. Make sure that these out-of-state debtors, they're trying to talk that the debt buyers are taking it because of all these credit card companies. I went, okay, this is, again, change the mantra here. No. The credit card companies aren't who you have to worry about. You're killing our banks, okay? But yes, we'll agree to this. We'll go with the earned income tax credit. In fact, we're working with Brenda Carter to say, we'll support you on that. Let's get that through. We're fine with staying away from that when we garnish you, the tax garnishments to stay away from the earned income tax credit. We're also saying, yes, we'll work with you on updating the garnishment exemptions, but let's not get stupid here, okay? Let's go back to what we talked about with the other coalitions that have put together and came up with reasonable rules. As Mike was saying, we're fine with being reasonable. They're arguing these exemptions haven't been updated since 1965. Partially true, partially not. Yes, we still have exemptions for pigs, hogs, cows, et cetera, that we can't take. Well, of course, we don't want those anyway. We need to upgrade some of these exemptions. That's fine, we'll work with it. But man, this is insane what you're talking about. You're taking that pendulum and throwing it all the way over. And again, when I talked to Senator Irwin, I asked him, where'd you come up with the numbers? Where'd you come up with these? And he didn't come out and actually say it, but what he did tell us in a roundabout way, we took the Joint Commission numbers and doubled them. Talk about arbitrary. The Joint Commission numbers were somewhat reasonable. We still weren't happy with them. They literally doubled them and threw that into the bill to kind of see what would happen. This is what we're dealing with. Okay. We're also dealing with his legislative assistant who in this meeting says, oh, by the way, last year, you know, we tried to get these other bills up and they didn't make it. I'm like, whoa, wait a minute. What bills are you talking about? Yeah, 3 or 4 of them. I was floored that these were coming out of a legislator's mouth of the things that they were trying to get up through the system. Luckily, we weren't watching them last time because it would have been a bloodbath. But anyway, a lot of the stuff didn't make it up the way. What the Michigan Creditors Bar is suggesting, number 1, more debtor contact, statewide e-filing, which we're working on, more access to justice for borrowers, consistency in timelines and actions, legal aid. We actually have a system we've suggested. When we file a lawsuit right now for a collection, $5, I think, of that goes to the statewide e-filing system to get the e-filing electronic system up in place. We're saying, look, throw another $2 on there and put that towards legal aid. Let's assist these borrowers. Let me throw a fact out there real quick, and Mike's coming up, so I got to move on. Very simply, one of the other mantras they're using is saying, we found that 55% of the time when you have an attorney representing you, your case is dismissed. So they're trying to get you to believe that simply by hiring an attorney, that means that the collection was incorrect. Absolutely not. When you have an attorney, that attorney negotiates with us, we get a payment plan in place, and we do dismiss the case, what's called a conditional dismissal, which means we're conditioning upon the fact that you make your payments, and then we'll make it go away if you make all your payments. They took that number and said, oh, you get an attorney, you get it dismissed, the debtor, the debt was wrong. Garbage. Absolutely not. Court provided disclosures. These are some other things that we're looking for supporting and pushing it through. Through the efforts of Mike, and I got to tell you, as soon as, and this is not just a plug for Mike, this is true. Mike took this on. We were on the phone probably at least twice to 3 times a week while we were going in. He got us an immediate meeting with Joe Tate. We sat down and Joe says, I'm good, Speaker of the House. We're not talking about this. We're leaving it alone. Brenda Carter, all the other folks that we've talked with, we sit down and spent some time with. We're pushing this forward. The CBM has really been assisting us in making inroads and stopping these. Yet, you saw the numbers before, there's a possibility these suckers are going to come through in some fashion. We're trying to work with them, trying to make it happen so that it's reasonable. There's certain things we want to adjust and fix, but across the board, if this isn't scaring you when that debt ratio goes up, when your charge-offs start creeping up and now you can't get it back, if it's not calculating into your numbers, I didn't do my job today. Now it's lunchtime.
Yeah.
Any questions?
Thanks, Stuart.
Yeah. Thanks.
Stuart's been absolutely fantastic. For all the bankers in the room, they understand bankruptcy garnishment. It's not the best part of our business. You never want to go there, right? You make a loan, you're trying to help somebody buy a house, trying to help them get a car. You need them to pay back, and bankers will do just about anything to work with a client to try to help them through a difficult time. But when all else fails, you got to be able to collect. But these bills won't just hit banks and credit unions and credit card companies and auto loan companies. These will hit every one of us in this state. So for you college students, like, well, okay, you know, I'm not even taking out any loans other than student loans right yet. But let's say you're driving down the street and it's really gonna have to happen in a parking lot, because I think it's the only place where you can still sue now. But you're in a parking lot and somebody backs into you. You're gonna go to your insurance company, they're gonna go to their insurance company, you're gonna get something, but it might not be enough. And if you are legally parked, you can sue them for the deficiency. But under these statutes, if they pass, not happening. Anything else that happened where a deal went bad that you had with somebody and you tried to collect it, you're probably not gonna be able to collect it. Now, we're gonna help the legislators see that. They don't even know that. They don't understand financial services. They don't really understand what they're doing with these bills, but we're working on that. There is room. There is room to provide some consumer protections that maybe increase consumer protections, but still don't create undue hardships to people who lend money. Because what will happen if the hardship goes against the people who lend money, you always pay for it as a consumer in the end. That means that they're going to raise their prices, which means there's going to be less credit available for low to moderate income people, and it's going to be more expensive for them in the end. So what we're really fighting for is to try to just make sure that these changes are reasonable, things that everybody can live with. Oh, and by the way, we can always make other changes down the road later if we didn't get everything the first time through. So we're going to break for lunch right now. We'll be back at 1 o'clock sharp. Those of you who are on virtually, please get your lunch. Be back with us at 1 o'clock for Bill Grenier. He's going to be great. And those of you here, we're going to head out for lunch and we'll be back at 1. Thanks.
That's absolutely. All right. Did I tell you that story, or did you know that? No, you told. Yeah, I did. Yeah. You know how? Did I tell you the story of how that came about?
Yes, no worries. Understandable that you're-
Just let her know.
Yeah, William the Conqueror.
Look at you.
He's adjusted, he's gonna sit.
Yeah, I know. Sure. Here, it's only 1%. I can live up to 1% of that. Yeah, so soft G on the first name and then hard.
No, it's tough.
It's right after one.
It's a super confusing name, right?
Good afternoon and welcome back and welcome to our closing speaker and our keynote this afternoon. I know many of you have been anxiously awaiting our economist. As Mike mentioned earlier, my name is Kate Engels. I'm the COO here at the CBM and want to extend my thanks to all of you who took the time today, again, for those who braved the so far non-weather here in Lansing. We haven't seen a flake, but it is coming and we know it's in other parts of the state already. And the 90 plus that are joining us virtually. And I know that many of you are probably coalesced in a room with multiple cohorts, so it's probably many more than that. So Bill, you've got a good group awaiting your remarks. For those of you who were lucky enough to join our economic forum last year, you had the pleasure of hearing from Bill flying in once again from the beautiful warm weather state of Arizona to deliver our economic outlook. I don't know if you've been looking at the bank earnings releases. They've been coming. I keep checking my phone and might even have more late breaking news than Mike, you were able to share this morning during your presentation. But by way of an introduction, Bill is the chief economist of Mariner Wealth Advisors and drives the economic and capital markets outlook for the firm and supports the investment team with tactical asset allocation decisions. Your experience spans 40+ years. And prior to joining the firm, he has a host of other accomplishments, which I will not read off,
That's fine.
so that we can get you up on the stage and get you talking. So without further ado, welcome Bill Greiner.
Today that I was sick, number one, I just got done with a great lunch and I need to sit down and let that digest for a little while. And also it's a small enough group that I want to try to make this as comfortable and as casual as possible. If you have questions, feel free. We can even interrupt if I'm in the middle of a particular topic. I'll be happy to stop that topic and try to answer your questions. That's right. And go along.
Maybe
Yeah.
turn it on, yeah.
I need to turn that machine on. Sorry about that. My daughters say that I'm a wizard around electronics, meaning that electronics blow up when I approach them. I'm not an electronic kind of person. The Tech Help Center makes their living off of people like me. Let's see. Is that right? There we go. Okay, good, good. Other people at home can hear me also. I'm in Arizona, have been in Arizona for 6 years, and I'm with Mariner Wealth, as was mentioned, and Dave Barnes is a good friend of mine, and Dave and I've known each other now for about a year or so. And Dave is an asset manager and manages assets for an asset liability structure for Michigan banks and banks around this region. Does a great job. How many billions of assets do you folks have under management now, Dave? 11 billion. So I just wanted to mention that Dave is here with me, and I appreciate the invitation to meet all you. Dave and I attended a Mariners internal seminar that was held back down in Dallas earlier this week, and there were 600 wealth advisors at this confab, and I was one of the guest speakers, but also one of the guest speakers prior to me making my presentation as far as my economic and capital market outlook for this year was Jeremy Siegel, and he spoke the day before, and many of you, I'm seeing a lot of shaking heads, know who Jeremy Siegel is. He's on CNBC a lot. He's one of the talking heads on CNBC. He's a professor at the Wharton School at the University of Pennsylvania, and he's an economist. But he also does a lot of work in capital markets like I do. What I found out about Jeremy Siegel during his presentation was that he was a very strong monetarist economist, as I consider myself. One of the questions that was asked of him was, is the Fed doing a good job? You know, is the Fed on spot? Are their policies appropriate? Are they doing the right job right now? And he kind of chuckled and he said, well, as a monetarist, I can tell you that the Fed, he said, I think did an absolutely terrible job coming out of the pandemic by continuing to pump money supply and to a point where we monetarists knew that there was a risk that inflation was going to start flaring up. That inflation certainly was not transitory as long as M2 is growing to the degree that it was following the pandemic. And he said, so basically they killed the economy because they let inflation get out of hand, and the inflation, of course, peaked in June of 2022 at about 9.1% on a year-over-year basis. It was a big number. He said, now, a lot of people, since then, they've been tightening down and raising interest rates. Money supply went deeply negative about 6 months ago or a year ago, and inflation has come down rather dramatically. And so a lot of people are hailing Chairman Powell as the savior of the economy. And he said, as far as I'm concerned, what the Fed has done since the pandemic is they basically run over a pedestrian with a car, a big car going very, very fast. But they were smart enough to basically stop and pick up the half-dead body, put it in the car and take it to the hospital where the patient survived. So is the Fed done a good job or not? That really depends on your time horizon, I guess, and really your outlook of whether they've done a good job or not. So I thought that was rather clever. Now, I'd like to take credit for that, but that was Jeremy Siegel, basically his concept as far as where the Fed is. And so today I'm going to talk about a little bit of rehash of where we've been, where we were in 2023, what happened that year. This time last year, I made a presentation to you all
And I made the comment that I thought that inflation, not inflation, excuse me, got the wrong thing here. That recession very well might be in the cards for 2023. We use two primary models, historically based data models that suggest the higher probability or lower probability of recession. And both of those models were screaming at me saying high probability recession sometime in the next 12-month period of time. And so I think at this presentation, I suggested that recession was high, the probability of recession was much higher than normal. And I'm still saying that, excuse me, saying that's the case. Get a little water here. Maybe not as high as it was this time last year, because the models are starting to moderate a little bit and the Fed's taking the right action. But the yield curve is still inverted. This time last year, it was deeply inverted. The 6-month rate of change of the leading economic indicator index is still deeply negative. And whenever in the past we've seen both of those models basically flashing those red lights, going back over the last 8 business cycles, we've had 7 times we've had recessions within a relatively reasonable period of time. This time around, we haven't seen it. Now, there's a caveat to this, kind of an asterisk beside that statement. And that asterisk is, if you look at those previous 7 periods of time, we've been into recession following inversion, you ask, what is the length of the normal lag time between inversion and recession? Milton Friedman said that the monetary policy always hits the real economy with a variable and meaningful lag. He never said this number of months or that number of months, but variable and meaningful was his statement. If you look back over the last 7 cycles, when the recession did follow a inversion, the average period of time between sustained inversion and the oncoming recession was 14 months. That was the average. And the range has been anywhere between 6 months and more than 2 years. So when the question then comes, all right, if we still are thinking that recession might be in the cards for 2024, which I think the probability this year again is lower than it was last year, when do we start the clock running? And the answer is we hit a sustained inversion in the summer of 2022. So you can take that basically and run that forward for 2 years. And so the clock is still running. We're getting in the latter innings or the latter stages of the ball game here as far as the recession is concerned, the lag period, the 2-year lag period or 2-year plus lag period, and that runs out sometime around the election of this year, which lo and behold, who knows? By the time we hit, if we do enter recession, let's say late summer, early fall, that's going to be within 30 or 60 days prior to the national election, and the NBER, the pointy-headed economists who decide, yes, we are or we are not in recession, normally take about 6 months to make that call, and by the time the election's come and gone. So who knows, I guess is a good way to frame it. But this all raises the question in 2023, why didn't we go into recession? What were the factors that led us to avoid a recession last year? What are the fundamental economic factors? And people can say, well, the Fed started reducing interest rates, so on and so forth. I would say it's deeper than that. I would say it's deeper than monetary policy as far as why we've avoided recession this time around. And it has to do with the consumer. Consumer, we all are aware, if you look at C plus I plus G plus net X, that's the formula for figuring out GDP. C being consumer, I being investment, G being government spending, and net X is net exports. You take those data points together and you add them together, you come up basically with GDP on a nominal basis. And if you look at that data historically, going back over the last decade or so, or 2 decades or so, consumer represents about 70% of that number. That's the number that I think everybody knows. What the number that not a lot of people are really focused upon, but is factual, now that we have 4th quarter GDP data kind of in the books, well, it's maybe up for another revision or so, but pretty much in the books. If you look at consumption of the growth rate we saw last year, which came in nominal GDP growth, again, it's still not yet in the books, but it's going to be right around 2.8. Is probably going to be the number we're looking at as far as not total real GDP growth last year. Of that 2.8% growth, 80% of that growth came from consumption. 80% as compared to a baseline normal participation rate of 70. So the real driver behind the 2.8%, the oversized driver behind that 2.8% total GDP growth rate was consumption. So we sit back and say, well, let's talk about the sustainability of that trend. How sustainable is that trend for consumers to continue with flags flying and trumpets blaring to lead that parade? How sustainable is that? We look at three triggers or three buttons that consumers can push. Let me go to the first slide. I think this is rather clever. Let's go to the first. Consumers can push to basically fuel consumption. The first is savings. Amount of money that people have in savings and go out and spend that money in savings. And of course, government was very big on sending people checks during the pandemic. And then the year following the pandemic, coming out of the pandemic in 2021 and 2022, to a point where, according to the folks at the St. Louis Fed, excess savings, and how they define excess savings is, if you look at trend line savings rates and compare it to the size of the economy, there should be some kind of a reasonably predictable level of normalized savings patterns within our economy. And they're suggesting following, or in 2020, let me get the right word, 2021, at the end of 2021, excess savings totaled $2.5 trillion with a T. With a T. Our economy is about a $27 trillion economy. So that represented about 8% thereabouts of nominal GDP growth that consumers go out and spend and not really worry about taking money out of their paychecks, nor basically money by borrowing more money than that. So there was a lot of firepower basically in savings, and that's what fueled a lot of discretionary consumption patterns over that 2 to 3 year period of time with those savings balances. Those savings balances, again, according to the St. Louis Fed, are now down to less than $500 billion. Still a decent sized number, but that from 2.5 down to less than 0.5. So the consumers have been busy paying that money out, basically spending that money for consumption over the last couple of years. The next thing we can look at is, what about debt? Consumers basically been riding a debt wave, or has debt basically been not that big a deal one way or the other? Revolving debt levels, revolving credit by consumers over the last 2 year period of time have gone up by 30% in 2 years. Normally speaking, that number on any particular year period of time, recessions, good economy, bad economy, over a long period of time has averaged 3% a year, 3% on revolving debt. Last 2 years, it's up 30. So revolving debt has been growing at 5 times what it normally has grown by over the last 2 year period of time. So I would suggest that another reason why we haven't seen, or we didn't see a recession last year, has to do with consumers taking on a lot more debt within credit card balances and other revolving credit lines. Third thing is the jobs market. The jobs market has been very robust, very sound. Wage rates have been going to the upside to one degree or the other, and now finally starting to exceed inflationary pressure. But the jobs market is starting to wane. Now, if you look at the data that comes out the first Friday of every month, it comes from the Labor Department, basically the color of the jobs report. It's up for 2 revisions every month, by the way, and those revisions at times can be very, very large. But this time last year, how I look at that data is I tend to look at that data on a rolling 3-month basis, because the data each month is like this. It's very volatile. And like I said, it's revised twice over the following 2 months to get it basically back to foot with other data. So I look at 3-month rolling data regarding the jobs market. This time last year, the economy on a 3-month rolling basis was creating 320,000 new jobs a month. 320,000. Now, to break even with population growth, with growth of the labor market as far as new people coming in as compared to those going out, roughly speaking, our economy needs to grow about 150,000 jobs a month just to break even. All right, so that's kind of your baseline numbers, 150. Anything south of 150, the jobs market is truly contracting. Anything a lot more than 150 is really expanding. So that's kind of your baseline growth rate where things are kind of neutralized. 320 was where it was this time last year. Latest 3 months, 160. The job creation rate has gone down by 50%, gone down by half over the last year. So the jobs market is, while it's still okay. At 160, we're basically in a neutralized position with the jobs market right now. This time last year, we were growing like Topsy as far as jobs were concerned. Employers having a real hard time finding bodies basically to fill slots. And that seems to be going kind of by the wayside now. So and a jobs market, a robust jobs market, gives people confidence, gives them the confidence, the willingness to go out and spend that excess dollar. So we have both the ability being represented by debt structure and also savings rates, and the willingness to consume that being shown by the state basically of the jobs market, where those things have been powering consumption activities as we move forward. I would suggest that most of those catalysts this year aren't going to be as powerful. While they still may be okay, they're not going to be as powerful as they were in 2023. Now, the picture I have up here on the first slide is landing a large plane on an aircraft carrier. Soft landing is the soft landing, the impossible dream. And if you look at, again, over the last 8 business cycles, the Fed has only successfully created a soft landing environment once, and that was in 1995. Right? Beyond that, all 7 others prior and following 1995, the Fed, while they were trying to create a soft landing, they failed. It's a very tough thing to do when you start to consider, as I was mentioning before, the Fed starts to change monetary policy, and it may be 2 years before we see the actual impact of that policy change in the real economy. Now, the plane you're seeing up here has nothing to do with the plane landing on an aircraft carrier. That, of course, is Jimmy Doolittle's raid on Tokyo back in 1942, when I think it was B-24s, if I'm not mistaken. They took off from aircraft carriers and bombed Tokyo, and it was a big deal. So anyhow, I thought that was a rather clever thing, but that and $1.50 buy a cup of coffee somewhere. So that's kind of what happened in 2023. Was we come through an environment where the economy grew nicely. The end game number is probably going to be in the high 2s. I'm saying 2.8 after all the revisions are said and done. Since the end of World War II, the average growth rate in the U.S. economy is kind of our baseline has been 3.2. So even at 2.8, it was still a little shy of our normalized growth rate we've seen for the last 5 decades, but still a pretty good year. This year, we're calling for a number of about 1.5. We think the economy is probably going to be positive in its growth profile this year, but probably coming down pretty hard and still positive, still flying in positive territory. Coming down from a 2.8% number because consumption activity is probably going to take a backseat to a more well-rounded economy and an economy that's probably not going to be growing all that rapidly. My theme this year, as far as our economic theme is concerned, and I stated this at this Texas conference I was just at earlier this week, angels flying close to the ground is kind of the theme that I have for this year's economy. And I'm seeing some smiles out there, some Willie Nelson fans, obviously, of people that know that song. The real title of that song is Angels Flying Too Close to the Ground and Not Flying Close to the Ground. If we hit recession, then I'll change the theme to Angels Flying Too Close to the Ground, but we're not quite there yet. So anyhow, let's change the screen here if I can. Okay, highest probability economic theme for 2023 recession is tardy. Late last year, it was actually early fall. I made the call that the recession hasn't been called off, but it's simply tardy. And I suggest that we weren't going to see a recession in 2023. Indeed, we may see one in 2024. And I've already gone through many of these bullet points just verbally. There have been tardy recessions of the past, and these are some things that a lot of people really don't focus upon. But if you look at, compare the start of the four previous recessions and ask the question, when did Fed funds rate peak prior to the start of those 4 recessions? And you can see the average has been between 9 months and a year plus, roughly speaking, of the peak in Fed funds rate in the following recession. And all 4 cases of recession did follow, following the peak in Fed funds rate. This time around, August 23 is the peak 5 3/8, where we basically are right now, between 5 1/4, 5 1/2. It sure looks like it. It looks like the Fed basically is signaling that, guys, we're done. We're not going to raise rates anymore. So the peak basically, I would suggest, is probably in. If that's the case, then based on this 4 previous cycles, could we expect to see a recession this year? Absolutely. We may expect one. We might expect one. But is that the highest probability scenario I'm calling for this year? Probably not. To give you some numbers. Last year, I thought we had a 50-50 shot, a coin toss chance that we're going to see a recession. This year, I think the number is probably closer to 35%. Now, baseline, I like to talk about baselines. Since the end of World War II, our economy's been in recession 12% of the time. So that's kind of your baseline, any particular year or another of our probability of being in a recession without knowing anything about what's going on in the economy is a 12% number, all right? This year, I think the number is 35. Last year, I thought it was 50. So I still think we very well may see a recession this year, but it's not our main call. Our main call is suggesting a soft landing very well may ensue, and we may see this 1.5% growth rate in GDP come to pass and escape a recession. Consumption growth, as I mentioned before, was 80% of the growth rate in the economy last year. It came out at 5.4% growth rate for the year, 5.4. The long-term average going back over the last, well, this is since 2000, the last 23 years, has been 4.6. So you can see that number, the consumption growth rate we saw last year was reasonably higher than what we've seen on average for the last 23-year period of time. This year, I'm suggesting consumption growth rate of 4.4. We were at 5.4 last year. I'm thinking 4.4 this year. So a little bit of softening in consumption growth as we enter 2024. And my GDP growth expectation, as I mentioned before, is 1.5. Okay, let's see what we have next. Understanding why recession is tardy and soft landing is viable. And you can look at all this data as far as jobs market and cash infusion and spending on manufacturing, so on and so forth. Government spending was a big deal last year. It's going to continue to be a big deal this year. It's an election year. Government spending isn't going to go down this year. If anything, it's probably going to go up more, right? Last 3 months of last year, during that calendar quarter, government deficit spending totaled $0.5 trillion. $0.5 trillion for the 3-month period of time, not unannualized. That's just the 3-month number, $0.5 trillion. And if somebody has a question regarding deficit expenditures, I'll be glad to give you my thoughts on that a little bit more deeply and crawl into the weeds with you. Our core forecast of numbers for 2024, GDP growth 2.5 in 2023. That's actually going to be 2.8. This is about a month or so old. I have to create these things and get them past my compliance people, and that takes about 60 days. So some of these things are a little stale, and I'll bring them up to speed as far as what they really are. GDP growth from 2.8% in 2023 to 1.5 to 2 in 2024. First quarter GDP growth this year, I'm suggesting something around 2% for the first quarter. Not bad. It's an okay quarter, down from what we saw the last couple of quarters, but still a decent number. 2.4% in the second quarter. I think we're going to see a slight acceleration as we come into the second quarter. I think it's going to be primarily driven by government spend. All right, and a weakening trend during the second half is what I'm looking for. Look for 1 to 1.5% GDP growth during the second half. Basically, the economy comes into a stall mode, where growth in general is probably going to start stalling pretty heavily. Even though the Fed is going to continue to, even though the Fed, in my mind, is going to start lowering interest rates. But remember, there's a lag between the time they start lowering the interest rates and economic activity ensues. All right. All right. Unemployment rate rises to 4.5 by the end of the year. I've been told by people that really understand this that once unemployment reaches 4.5, it's now at 3.7. Once unemployment reaches 4.5, the Fed is going to start to act. And I would suggest that probably happens sometime in the early to midsummer time frame. That's what when I'm looking for the first Fed rate decrease on Fed funds to occur. And I'm looking for 4 rate decreases as the year unfolds. Inflation contracts from where it is today at 3.7, reaching 2.5 to 3 by the end of the year next year, with that being core CPI. Fed lowers Fed funds rate to 4.25 by the end of this year, down from 5 3/8 as we speak. 2 periods of Fed activity. Because it is an election year, there's going to be a period where the Fed goes on pause, more than likely. They don't like to be labeled as a favor of one political party or the other. And they're very sensitive about that because of their mandate with Congress. So what they'll probably do is they'll be aggressive or active late spring, early summer, through the summer, then pause until after the election. Then they're meeting in November and December, they'll probably lower again. So they're lower rates, in my mind, are kind of those 2 bedposts, more than likely as far as time is concerned. That's kind of what I'm thinking of right now. Remember, it's election year. There should be both the timing of the Fed policy and fiscal spending would probably change. The politicians in Washington want to make sure that federal spending, when it happens this coming year, people understand it like it prior to the election. So I think a lot of government spending is going to occur in the first 6 months of the year. So that's kind of what I'm thinking of for this year. I think it's going to be a positive year. I think it's going to be a year that's marked by Fed rate decreases, looking for 4 Fed rate decreases. And I'm looking for a year where, and I could step through a lot of data on this if you'd like me to, I think we're looking at a steepening yield curve for this year, where by the end of this year, short-term rates are going to be lower than long-term rates. If I'm looking for Fed funds, let's say at 4, what's my thought on the 10-year treasury? I think the 10-year treasury fundamentally is anchored between 4.25 and 4.5 pretty hard right now. Right now, I think we're right around 4, if I'm not mistaken. I think that's where I saw the 10-year treasury trading yesterday. So I really don't see a lot of movement in the 10-year treasury for much of this year. It's probably going to porpoise to one degree or the other. But if my thoughts are right as far as the weakening in overall economic growth, and the Fed understand that, and if my unemployment number is rational, then more than likely the Fed is going to start taking action this year, and they'll probably start sometime late spring, early summer. Where I'm getting my idea that the 10-year treasury is anchored, somewhat anchored in the low to mid 4s. I went back and looked at, again, the St. Louis Fed database and took my data back to 1960. I'm sorry, 1970. And I asked the question, what is historically been the real average real rate of return on the 10-year treasury or and above headline CPI? And the, excuse me, the answer is 1.7%. So if you have a headline CPI number, as I'm suggesting, at 2.5, and we're in a normalized environment, which we may not be, I don't know, but I'm just looking at that statistically speaking over the last number of decades, that would tell me kind of the middle trading spot for the 10-year treasury this year should be right around 4.2, something like that. And right now we're at 4. So that tells me the 10-year treasury, given yips and yaws and fits and starts, is probably anchored here somewhere in the low 4s. And the Fed funds coming down. What I'm doing with my clients' money, the first thing I'm doing on the fixed income side, if they're holding on to excess overnight cash, I'm starting to look at the idea of putting that money to work over a 6 to 12 month period of time. I'm starting to take some of that money out of cash balances and extend the duration on that money slightly, not huge, just slightly. I'm trying to lock in that short-term high yield, which is still the sweet spot of the yield curve as we speak. I probably shouldn't talk about this. Dave's the expert when it comes to asset liability management, but that's one of the things I'm doing with this outlook. That's one of the things I'm doing. I'm not rushing out and buying a bunch of 10-year credits right now, but I am looking at the idea of getting some money out of cash in my clients' portfolios and putting that money to work in 1 to 2 year credits. Next thing I want to talk about, and this is something that I've been working on for a year, and I'm running out of time. I'll try to make this quick. I think that life in general, and I was talking about this at lunch today, life in general, we all travel from one life room to another throughout our lifetimes. We're in the child room for a period of time. We leave that and go to the student room. We leave the student room and go into the young adult room. We leave the young adult room, go into parenthood room. We leave there, we go into old age room, or whatever it might be. There's probably a lot of intermediate rooms in there, one way or the other. But in between each one of those rooms, there's a passageway where we're not really fully ensconced in one room or the other, but we're kind of going through transition. And that's how our lives basically tend to unfold. And that's kind of the way we as humans operate. I would suggest the economy basically operates in somewhat the same fashion. We're in a room where things were really, really deep, really ingrained. We understood how the economy operates, and then we start to leave that room. We're going through a transition phase, let's call it a passageway, into a new room. And I would suggest, for example, the economy was in a very distinct room from the end of World War II until the mid-1960s, all right? Left that room until 1982, and that was a brand new room also, from 65 or thereabouts to 82. From 82 until the year 2000 was a very definitive room of lowering inflationary pressure, lowering interest rates, high GDP growth rates, capital markets doing really well and declining interest rates. All right, from 2000 until now, I would suggest we've been in another room. And now being probably 2 or 3 years ago, let's call it 2018, 2019, 20, the pandemic basically kicked a new room in front of us. And right now, I would suggest over the last couple of years, we've been going through this passageway, leaving that old room and coming into a new room, and that new room is completely out of focus, but we may have some ideas as far as what it might look like. So let's take a look at the old room. There's a period of never-ending disinflationary pressure. All right, that's number one. Number two, a period of rapid growth and globalization of the world's economy, which basically led to the disinflationary pressure. To follow on the trade issue, according to World Bank, global deep poverty, those people basically that were dying on the streets and couldn't afford feed themselves and their families, deep poverty rates declined dramatically. And I think the data that I've seen is that deep poverty declined by almost, I think the number was like 60 or 65%, which most of that occurring in Asia. Africa still deals with deep poverty levels on a mass scale. But back in the 1980s and 1990s, China couldn't afford to feed their own population. There are people dying in the streets in China. Now they're the world's second largest economy. A period of world peace, particularly for the developed nations. Yeah, we fought in Afghanistan ourselves for a period of time, but if you look, and I hate to be morose about this, but if you look at the casualty rates in Afghanistan, it doesn't compare to the Vietnam War nor certainly World War II. So it was a war, but it was a fairly light war when it comes to U.S. casualties. Global economic power, particularly global manufacturing capabilities, shifted from the democratic to the autocratic group of countries over the last 20-year period of time. And that helped drive the disinflationary pressure, which helped drive, which basically globalization was the driving agent. Additionally, government spending and debt levels in many cases have grown more rapidly than economic growth, leading to government spending and borrowing being more impactful today than perhaps was the case prior to us coming into this current room we're in. So that's kind of the examples of the old room that we're coming out of. Now, what about the new room? What are some of the things that I'm suggesting might be included in the new room? From a demographic standpoint, the world's major economies are all aging. Let me give you some thoughts with this if I can. The baby boom generation, which many of us, not all of us, but many of us in this room are of that generation. Birth dates between 1946 and 1962, I think it is, over that period of time, with the peak birth rate occurring in 1957. We were in the 1970s and 1980s, baby boomers were the driver, political driver, economic power driver in our country. That generation drove the boat. More people were coming of age, becoming a voting age during that period of time, becoming consumption age during that period of time, and leadership age during that period of time from the baby boom generation. Now, members of the millennial generation, from a voting standpoint, outnumber us. There's more voting able, millennials who are able to vote. Now, whether they vote or not, it's a different question. They're able to vote more so than baby boomers. Baby boomers are starting to die off. All right, we're now starting to die. And millennials basically have picked up that baton and they're starting to move forward. So the demographic shift that's happening in the country is generational in nature. It's generational in nature. The last time we saw this kind of shift in our country was the 1960s. I'm suggesting something like late 60s, 68, 69. There's a lot of things happening at that time that are the same things happening now. There's a lot of unrest, civil unrest at that time. There's a lot of civil unrest today. There's a lot of political friction at that time. There's a lot of political friction today. So some of the problems we had and factors that led into our societal changes, changed economic fabric, I think are also present, are starting to become present today. Global political friction may continue to escalate. I already talked about that a little bit. And that has to do with what's been going on in the old room for a while. Onshoring the manufacturing capabilities may become the norm. And I think it's more than just onshoring. I think it's also multi-shoring. Instead of a manufacturer that's assembling products here, let's say in Michigan, getting products shipped in from China, they're getting products here from here in the United States and also from Mexico and maybe from Canada, other areas besides just China. That multiple factor really is driving some things. One of the things that drives is inflation. Higher cost structure very well may be in place. High levels of global political separation as countries align their interests more directly with either the democratic group or the autocratic power bases. And I think you're starting to see this globally, where you have India lining up more so with the democratic group, and you have certain other countries starting to line themselves up more directly with the autocratic group. What this leads to is potential, not necessarily going to happen, but potential of some kind of a major conflict between those two power bases as we go forward. Economic conflict, or maybe, heaven forbid, some kind of political conflict. The days of ever higher globalization of the world's economy as a percent of GDP peaked 4 years ago. Not a lot of people are aware of this, but if you look at trade activity and compare it to global GDP, That number, and look at that ratio, the number peaked 4 years ago. Since then, it's been in decline. So what I'm suggesting in this new room, the deglobalization has been going on now for about 4 years. Now I would suggest the forces that are making that happen will probably continue at varying speeds to impact world economies as we move forward. I think Michigan, for example, is probably a benefactor of these trends because of your industrial base in this state is much stronger than a lot of other states. And I think that's an area that probably here in the US sees some decent growth going forward. Government spending as a percentage of GDP should be higher on average than has been the case over the historical longer term. And we expect higher overall inflation pressure between 3 and 4% on average going forward over the next 5, maybe as long as 10 years out. I'm suggesting right now, formally 3 to 5 years. That's about far out as I can see with any kind of clarity at all. So I think in general, not just looking at 2024 and comparing it to 2023, keeping these things in mind, that if we are coming into a new room via this passageway we're going through right now, it may make some sense to start thinking about that from a structural standpoint with your boards and with your senior employees. And the lawyers like you to read that stuff. So anyhow, that's about all I got today. Any thoughts, questions, or comments? I'll be happy to try to field them. Yes, sir.
I don't know if it's a question, but I thought it was interesting on your recession party chart you had up there from when the rate peaked to when the
Yeah.
yeah, that one right there where
Yeah.
the recession started. None of those recession started dates. Well, I guess 2020 are presidential election years. I just wonder if what's going to happen this year also will be because of presidential election and the influences you mentioned with, not too many things happening that are out of the norm, push whatever could happen and we still might be looking at something happening in 2025, or if there's enough time between now and then whereby some of these other variables will stabilize and we make it through and we start the upswing.
That's a really good question. And it's something I ask myself a lot. And I fall back on why is the recession risk present? Recessions occur because something's out of balance in the economy. And that's the reason recessions happen in general, is that out of balance factor needs to be fixed. And I would suggest this time around, the out of balance factor is inflation. If we get inflation back down to 2 and we stay there, we may go another 2 or 3 years before we see a true threat of another recession. So the key really has to do with, can we get down to the Fed's target of 2, 2.5, roughly speaking, and stay there? And I think if you go, now we go forward to this slide and you look down here on the bottom, overall inflation pressure of 3 to 4, if that comes to pass where inflation is higher than the Fed's stated target, the Fed might not ease rates as aggressively or as forcefully as they possibly could. And in that case, then 2025 very well may be a recession year. Normally speaking, if we see economic troubles, it's normally the year after the election. And government's fine with that because they got another 3 years to fix things before they have to stand for re-election. So that's maybe an answer to that. One other thing I want to make a comment about that I think might be on your minds here as bankers. Fed's quantitative tightening policies that they've instigated now for the last year or so, or 2 years, I would suggest going forward, I'm hearing rumbles on the street that they're going to start easing that tightening policy over the next month or two. You very well may see added liquidity coming into the treasury markets and into the system through the dealer system, as the Fed basically wouldn't allow all of their maturities to roll off without replacing portions of them. And they may modify those policies over the next 30 to 60 day period of time. Because I'm starting to sense that there's a real liquidity, there's a building liquidity issue within the banking system as we speak. And I think the Fed understands that. And I think their first step would probably be to try to alter their quantitative tightening policies.
Can I ask one more?
Yeah.
So what about immigration? You hear about immigration every year and the border crisis and whatever it is or isn't, and whether it be fixed or not fixed or changed in some way. But historically, I know a lot of economic trends also have deviations based on immigration factors. So how do you see that playing out in the next 12 months as well, or 2 years?
Well, I don't want to get too political here. I think part of that depends on who's going to be our next president. And I don't know the answer to that. I suspect, and I'm just saying this because of the current polls, and this is my choice, but I suspect if a rather central Democrat and not a far left-wing Democrat, or a central Republican, not a far right-wing Republican, winds up as being one of the two nominees, irrespective of who the other party is, that person probably wins the election. Would be my guess. I think people are tired of dealing with the far left and the far right both, you know. Yes, sir.
Kind of related to that, I remember seeing an economic summit, it was right before COVID hit, in the fall of 2019.
Right.
And the economist that was presenting talked about the misery factor
Right.
and how that might impact. So in that presentation, all of his forecasts into the future were based on Trump winning
Yeah.
a re-election.
Right.
So everything, that was their trajectory, but of course things change.
Right.
Do you calculate that misery index into this, or, you know, kind of?
I don't, but I can tell you what that number is right now. It's basically inflation plus unemployment. That's the misery index. And so unemployment right now is 3.7, I think, is the number, if I'm not mistaken, and inflation is 3.7 also. So that number is 7.4. That's a kind of a neutral number. It's down a lot over the last because inflation has come down so far. And we had peak inflation of 9.1 back in June of 2022. And at that time, unemployment was very, very high because we're coming out of still coming out of the pandemic. So, you know, 2 years ago, that number was really high. Now it's come back down to a more normalized level. And that would suggest that if it's normal, if it's neutral, then neither party, the incumbent nor the challenger, has any particular advantage one way or the other. But that's a good question. Yes, sir.
We have some Fed interest rate cuts in the spring, maybe leading up to,
Yeah.
leading up to the summer.
Right.
Have you looked at mortgage volumes, and will there be a refi boom based on the number of mortgages that have been made in the last few years that have had more than above average rates? Will there be a boom? Is there enough there to do a boom?
Well, there's enough there to create some traction. While I was running the number of the 10-year normalized yield relative to the underlying CPI number, I also ran the number for 30-year fixed rate mortgages compared to the 10-year treasury. And the spread historically, going back over the last number of decades, the spread between 30-year fixed and the 10-year treasury has been about 1.8%. So if your target, let's say, for the 10-year treasury is 4.2, then I would suggest the 30-year mortgages should be trading right around 6. And they're well north of that right now. All right. Let's say we come back down to that kind of a number, maybe even go a little bit through that number, and we get to the high 5s, low 6s sometime this year. I think that's probably enough to spur initial housing purchases.
And building.
Yeah, it should spur building pretty nicely. And in my numbers I have, I'm suggesting that in general, your housing activity is probably going to accelerate this year as the Fed reduces rates. But the Fed, because what that does, it starts to normalize the rest of the curve. Other rates that are spread out because of uncertainty, with the Fed starting to reduce rates, a lot of that uncertainty starts to disappear. So I think that you're probably going to see somewhere between a 70 and a 100 basis point decline in 30-year mortgage rates in 2024.
Good, thank you.
Yep. Yes, sir.
Back to the quantitative comments you made earlier with the Fed. You suggested maybe 2 or 3 months it may ease a little bit on that. Is that a short-term thing or a longer-term possibility?
I think it's a longer-term possibility, just for the reason that I think the Fed, if they make that move, they're tipping their hand even further towards more of an ease stance. And if they reverse that back to full tightening mode, then I think they send out a really mixed signal to the street. And I think they're at a stage right now where they really don't want to do that. So I would suggest it's probably going to have some traction to it. Other questions? Yes, sir.
Yeah, my concern is out on the long end of the curve with the central banks backing off, buying our debt, China, whatnot, our country not wanting to, our Fed not wanting to monetize the debt, blow out the monetary supply even further, inflationary. I think that adds a new wrinkle to long-term rates, and my fear is that there's not gonna be enough demand to feed the supply of debt we're gonna put out there. And so, so that, you know, what do you see that doing to the longer end of it?
I think it's a tempering factor, that's for sure. And I think if you look longer term, particularly on this new room we're coming into, I think that starts to feed into there very hard. We started getting some serious questions about that a little late in the last half of last year. And so again, I'm an economic historian more so than anything. I look at where we come from history, what do things look like now in relation to historical standard, and I try to kind of figure that out. If you look at the question of, I was getting a lot of questions from clients of how long is the US dollar going to continue to be the world's reserve currency? Which kind of feeds into your question also. And it's the true answer is nobody really knows, but the trends we've seen over the last few years, if you look at central bank, I'm getting this data from the IMF, central bank reserve holdings peaked with US dollars about 10 years ago. Since then, US dollar has been in decline as far as percent of central bank reserve currencies. It's down to about 51% of the average on a global scale, but it peaked closer to 70 a long time ago. So it has come down quite a bit, and over the last 2 or 3 years, it's been accelerating to the downside. I would suggest, and so to answer your question, I would think that is going to weigh on yields in the US. Our yields are going to have to be higher than would normally have been the case perhaps in the past. I don't know how high they're going to have to be before we basically just start choking things off, but it's probably not terribly high one way or the other. One of the things I'm thinking about with the new room, with that being one of the factors I'm looking at, but also the demographic shift of being another factor. I'm thinking that if we're in an environment that's more like the late 60s and 1970s, business cycles during that period of time were more powerful. They were shorter, whereas the business cycles we're dealing with now, you're seeing 7 years of growth in the business cycle followed by 11 months of deterioration, with deterioration, of course, being recession. Back between 1950, 1960, and 1970, business cycles lasted 4 years up, 1 year down. 4 years up, 1 year down. It was much more volatile, it was much more driven by inventory build, which is part of the new room. I think companies, because of the lessons they learned during the pandemic, are probably on balance going to be carrying heavier levels of inventory than perhaps they did back over the last 20-year period of time on average. So what you're talking about kind of feeds into that scenario where the business cycle is very well might be shorter than what we've seen for the last 20 years and more volatile, both on the up and down side. Are we done, Dave? I've exhausted these folks.
Sarah, what do you?
There are no questions in the chat.
Okay, great. Oh, thanks everybody for viewing in. Appreciate it.
Here are your notes.
Oh, yeah, I need those. Thank you.
Yeah.
Blinds to be interested in what I said.
Well, that concludes the presentations for today. I want to especially thank all of the students from the universities, both below the bridge and above the bridge, for joining. I encourage all of you, if you have any questions, this piqued your interest in banking as it did Mike, and you heard earlier, that reach out to any of us here at the CBM, and we'll be happy to get you in contact with a banker close to you. And thanks for everyone who joined virtually, and a special thank you for those who made the trip in person. It has, as a weather update, it's kind of pretty outside.
It's snowing now.
It's snowing kind of crazy.
There it is.
now.
Yeah.
So we are in fact in the snow. For those in person, please fill out the feedback form. We put these programs on for all of you, for the benefit of all of you. We are so fortunate to have terrific partners and associate partners and bankers who come together and help educate and inform. But we will and always do change them up based on the feedback we get. And I'll just echo Mike's comments when he said, you know, for the students, we would greatly value your feedback as well. You're coming in with a new and fresh perspective. And so anything that you'd like to see in the future, we'll be glad to include that as well. So with that, very safe travels for those who have to get in the car and depart. And this concludes our economic summit for 2024.